Now, before we kick off this exciting edition, we would like to take a moment to thank our partners. Moneycontrol India Fintech Conclave, powered by Incred Finance, event partners Couchbase and Ring, payment partner Cash Free Payments, and associate partner Reliance Industries Limited. The hashtag for the event this evening is MC Fintech Conclave 2024. Hashtag MC Fintech Conclave 2024. So start tweeting and sharing your insights with that hashtag. And follow our coverage of the event as well on Moneycontrol. We have a very exciting lineup of speakers this evening at the intersection of policy, innovation, and regulation. With that, I'd like to welcome on stage Moneycontrol's Managing Editor, Nalin Mehta, to deliver the welcome address.
Thanks very much, Chandra, and a very good evening, ladies and gentlemen, as we kick off the second edition of the Moneycontrol Fintech Conclave. Now, there was a time when foreign visitors coming to India would often be amazed by its cultural diversity. Now they're amazed also by its fintech diversity, and we're seeing some evidence of that in this room as well, with the excitement and the kinds of people who are here today. It can't but be otherwise in a country where in the last 10 years, financial inclusion has gone from 20% to 80%. Investments in the sector have gone to $31 billion US. Startups have grown by 500%. New bank accounts have gone from, well, about 500 plus million bank accounts, Jan Dhan accounts, which is basically the population of the EU entirely. And broadband users have gone from 60 to 940 million. Now, today, as we start our second edition of the FinTech Conclave, it's also a moment to reflect a little bit on how transformative a year 2024 has been for fintechs and for financial institutions. It's been a year where fintechs truly came of age, embracing emerging technologies like AI, pushing boundaries like never before, as well as navigating regulations and hitting the public markets. We were talking just before we started, and regulations was the big word with the big R that was being talked about outside. So we'll hear a lot about that today, how that's being navigated. In 2024, India's fintech sector reaffirmed its position also as a global powerhouse. We witnessed record-breaking digital transactions, the proliferation of embedded finance, transformative partnerships between banks and fintechs, and the accelerated adoption of AI in banking and in payments. But beyond the headlines, I think 2024 was also a year of resilience, a year where the industry tackled challenges head-on, from evolving regulations, and they have been evolving, to the ever-pressing need for innovation. But this 2024 story wasn't just about survival, it's also about thriving for India's fintechs. Now, as we stand on the cusp of 2025, the questions we face are both exciting and critical for the industry. How do we build on this momentum? How do we create a fintech ecosystem that is not only innovative, but also inclusive? It's also secure, and one that is also globally competitive. Those are the kinds of questions we hope to answer here. This conclave is a space to find those answers with leaders like Anand Narayan of SEBI, KV Kamath of Geo Financial Services, Ashish Chauhan of NSE, new age leaders like Kunal Shah of Cred, and a number of luminaries from across the sector, many of whom are already in the room right now. We will be exploring the future of fintech in India, the role of AI, the pathways to building more trust, more scale, and not to forget that we will also dive into the true potential that India's financial ecosystem holds when banks meet fintechs. 2025, we believe at Moneycontrol, is a year that is brimming with potential. It's a year where we move beyond boundaries of technology, of geography, of convention, to create a financial ecosystem that truly works for all. And that's the operative word, for all. Let this conclave be the starting point for bold ideas, for meaningful collaborations, and for actionable strategies. Thank you very much for being here, for sharing your vision. And once again, a big welcome to the Moneycontrol India FinTech Conclave 2024. Let's build the future together. Thank you.
Thank you, Nalin, for setting the tone with that very inspiring address. As he said, when foreign delegates come to India these days, they have to sample UPI and its magic before sampling other things in India. Now it's time to kick off the first session of the Moneycontrol FinTech Conclave. Future options have been a hot button topic this year in light of the recent norms by SEBI, but we're going to broad base this and talk about disruption in broking, navigating the new normal in terms of what new age and traditional brokers will do in the current environment, the growth opportunities, and curveballs ahead. To steer this conversation, I would like to welcome on stage N. Mahalakshmi, who leads all things markets for Moneycontrol, who's been tracking the space very closely. A huge round of applause for her. Let's also welcome on stage our speakers for this session, Shripal Shah, MD and CEO, Kotak Securities, Ujjwal Jain, CEO, Share Market, Prabhakar Tibari, Chief Growth Officer of Angel One, and Sandeep Bhardwaj, Chief Operating and Digital Officer of HDFC Securities. Huge round of applause for the first panel.
Thank you so much, Chandra. It's absolutely wonderful to be, starting this discussion, because pretty much the entire year we have been talking ad nauseum about, what will these F&O regulations really mean for the industry, for investors, all of that. That, of course, is a great news point. But the more important thing I was thinking when I was coming here, if you were to just rate industries based on the pace of disruption, I can arguably say that broking industry will definitely take, if not the top slot, amongst the top 3 or 4. And in the past 3 decades, I mean, things have changed so enormously, and every 5 years you see something or the other change, and the entire landscape change, the winners change. Back in the 90s, it was the electronic trading which disrupted everything. Then came all the foreign broking houses which brought in research, which changed the paradigm. And then the derivatives trading, which put out a lot of brokers which were reliant on Badla trading those days. Those guys went out of business. Then came discount broking, which, offline broking, which took away from, online broking, which took away from offline broking. And then came discount broking, and now even that is getting disrupted in a big way. So these are profound changes, but we will start with the first thing, first big disruption as we all see it, the F&O regulations. Let me start with Prabhakar Tiwari. Prabhakar, you are a leader in the industry. How do you see this going by March? Where do you think we will be in terms of volumes? Because only the first part of the derivative rationalization measures by SEBI has taken effect. The big one is to come in January. We've already seen a 30% drop in volumes.
Thank you, and hello everyone. F&O, the kind of growth we have seen in last post-COVID is phenomenal. And the guardrails which regulator has put in place was very much required. And the initial impact would be there because the retail trading behavior will change, because of such regulations. The impact, I mean, the market has given a 10 to 30% kind of impact as such, and all of us will be looking at various behavior depending on our customer mix and all of that. See, to my mind, this is a matter of a couple of quarters. The retail participation, of course, will go down. The certain trading volumes will go down. But the pace in which the new traders, investors are entering, this will cover up. If you look at examples of South Korea and even China, where there certain restrictions were put in place, the change was gradual, but it definitely happened. And we expect the same thing to happen in India as well. So I'm hopeful of the innovation which will happen. The speculative behavior will not change. It may change in terms of the product preferences as such, and the new players, new innovation emerging. So that's how I look at it.
Let me ask you, what do you think, Kotak Securities, what do you think will trading volumes really settle at by March? And I'm asking because he's saying it's only a couple of quarters. And I'm asking this, we will also ask the regulator what they think. but it seems that the regulator has been, has been fairly steadfast that we don't like this retail behavior or of excessive speculation, and therefore it has to manifest in terms of lower volumes. They have not articulated it like that, but it is just obvious that this speculation is not something that they look at positively.
Yeah, Mahalakshmi. So it's a right thought process. If you look at last 5 years in India, the entire country has become now, nation of investor from saver, or you can say investor come trader. Demat account growth is 5x in 5 years. F&O volume is multi-x. So obviously, mutual fund SIPs have gone to the rooftop. So in India, capital market participation has gone up. Now, in F&O, I think excesses was created. And any regulator would like to check that excesses. And the primary purpose of regulation is to ensure that there is an orderly growth. And to that extent, the 6-step strategy which regulator has proposed, I think is the right step. And definitely that would get the desired impact. We have already seen a couple of measures coming in play, and we have seen some impact coming in terms of cooling down of the volume, particularly at the lower end of retail. So I think the measures are calibrated in a staggered manner. It is not disrupting the entire market, but it is achieving the desired impact over a period of time.
Where do you think this should settle, Sandeep?
I think it's not about settling where the volumes will settle, how the customer behavior will settle. That is the important to answer. Because what Prabhakar and Shipal mentioned about, say maybe you may see some spurts on a positive side, on downside by any regulation change. And this regulation change has, and these are many, these are not one-off.
Yeah.
As even the taxes came before. So if I add that becomes one more to add. So from cost to opportunities, when there were weekly expiries, there were many opportunities to play. Now, when the consolidation of weekly expiries goes down and the contract size goes up, that will obviously create a lesser opportunity to participate. That will bring down not only turnover, but also opportunity to invest in derivatives. And that what eventually was the regulator concern, that heavy participation of the retail investors and losing money. If you look at, I'll give you one data and point. Say we have close to 16 crores, 17 crores Demat account, and active Demat account is 9 crore. Out of which, I don't think people will be able to guess how many people only trades in derivative. If I ask them, most of them will go around, it is less than 50 lakhs. Less than 50 lakhs people only trades month on month in derivative, and so much noise we are talking about. But they lose money month on month, the 50 lakh people, and
Yeah,
put together.
in fact, there is a number that I think SEBI itself put out. I remember Mr. Anant Narayanan talking about it, that a third of the total financial savings coming into the country is actually getting lost in F&O.
Yeah,
so
correct.
you might argue that there is very little participation,
50,000
but then in
crore,
terms of losses and unproductive use of
Yes.
money, it comes on top.
So when this kind of money, like 50,000 crore kind of losses, goes into the other savings instrument, even for the matter in mutual funds and ETF or the direct stocks, the probability of losing money in that may not be high. So I may not be looking at where the market will settle, where the turnovers or the derivative activities will settle, how we into industries will look at it, how we make our customers aware about it, that what is the right way of investing here. And as I think Prabhakar touched upon one point, the industry is still growing. Our penetration to the industry is not very high. The newer participants coming with a far more knowledge will take industry ahead. We may not sustain maybe for a few quarters, maybe for a few years, the kind of turnovers which we were doing in past. But we are very optimistic and positive as far as industry is concerned.
Fair enough. What about you, Ujjwal? Do you see the character of the market, the derivatives market, change in any way? And I'm asking this because one sliver of this point is that Jane Street made a very expensive hire from IIT Madras, and it was the talk of town. And looking at the pots of money that they may be making, it might just prompt a lot of other algo traders outside of India to look at India more seriously. Do you think that could play in our favor in terms of volumes?
So there are two parts to it. So one is futures and options, the way actually the collateral damage is the instrument, the way this whole thing has come out in Indian markets. Like the instrument is great because globally futures and options are needed to bring to hedge strategies, to bring market efficiency in pricing converging the price of the stock to the right price. Instruments are used from that context. I think in India, we took off on a very great note, which allowed weekly contracts are great. But I think somewhere as the segment was maturing, some gaps were stayed, and that actually led a lot of retail participation in a way FNO should not be traded. Like so suitability, understanding the risk, knowing that it's a leverage instrument, that understanding from an experience point of view was not well understood. That's why people ended up buying. Option buying is what lower end of the spectrum does a lot. I think with the changes SEBI is bringing, I think it will bring a lot of stability to the segment. Futures and options are important, which will help to innovate on the product side. And also people who actually now will trade will gradually shift towards understanding the product and actually trying to make a case why they are doing this. I think that is where the behavior will move. So that's on the consumer side. Coming to the other part which you're saying, see, I think again, this whole FNO linking it to somebody getting a pack like compensation at a college and doing. I've actually worked for a US Wall Street hedge fund D shop before starting up. So I can tell you, see, the way US markets and the hedge funds work, I mean, they really are built with a lot of computer science talent. I mean, because a lot of their stuff, which largely, especially in market making side, they involve a lot of build low latency applications which are closer to hardware, where they are closer to hardware, where they used to write on C++, and they build on network switches and all of that, which requires very good talent. So irrespective of whether I mean, an Indian IIT Madras guy actually got a compensation linking to FNO is not the right thing. US markets have always interacting computer science talent from India for a longest time. I mean, I am also an outcome of that.
No, but Jane Street rings a bell. I think the connection this time is because Jane Street has been in conversation, FNO is in conversation. And
I think they have been doing Indian markets, like trading Indian markets and doing market making for a while. I think it has come to the foray recently because of the whole linkages to retail losing money.
Right.
I think important for India is to actually create right guardrails from a regulatory standpoint so that actually we build a more vibrant market with more domestic innovation and even compete in the global landscape where people will trade in an open market setup. I think that is a better way to look at it.
Sure, Prabhakar, back to you. What if the regulator actually says that, you know, one of the prime reasons why they were against these weekly expiries, apart from the fact that money is being lost, is also the volatility on expiry days, which and you don't see that abating. I mean, now there is, you know, on Thursdays and Fridays, there is, look at what happened last Friday, huge volatility, 2,000 point move. So what if they completely scrap weekly expiries? Will that be a very huge disruption?
I mean, I don't see a reason why they should do it. You know, I mean, if you look at it, FNO is a great instrument, you know, hedging instrument as such, and weekly expiries were brought in for a reason. Okay, now the volatility would definitely be there, but without retail participation, the market liquidity would not be, the market depth will be missing, right? How much institutions will play, you know? I mean, the retail brings in closure points, you know, where like certain, you know, market making opportunities are there. So in my opinion, if weekly expiry go, of course, retail participation will come down, but I don't see that happening. I don't see a reason why that should happen.
People are as a, you know, when you think about your own, you know, P&L for next year, is the industry prepared for something like this?
In fact, you mentioned a very nice statement saying that discount broker disrupted the market and now they are getting disrupted.
Yeah.
So obviously the sharp fall if comes in derivative, and if brokerages who are depending on one segment of the market may feel the pinch more. At Kotak, like any bank brokerages, we are balanced in terms of the revenue segments. So whether it is cash segment, whether it is advisory, or whether it is a MTF and derivative, we have a balance in terms of the segment revenue. So any one segment having some regulatory impact temporarily might not impact us more. But yes, some of the brokers who have got large dependence on F&O revenue in a short term might have the pinch. But at the end of the day, two parts: whether you can increase the pricing. That is one of the question everybody has in mind, that will this force players to increase the pricing and, you know, reduce the discount. that can automatically take care of, I mean, how much pricing you can pass on to the investor and how much you can absorb. And second is that, as Prabhakar said, India has got large market today. We have still not penetrated enough. We are only 12% penetration versus US being 50% more. So there is a large part of market which is to be grown. So temporary setback apart, I think overall there is a growth path. But some players might have a little bit pinch more in the short duration.
Sure. Uh, how do you see the algo regulation? I mean, right now, I mean, just last week, SEBI put out this consulting paper on algo, where they're saying that everybody who runs an algo will have to now register through the brokers with the exchange. Is that, what is the feasibility of that? What are some of the compliance complications related to that? How are you preparing for it?
It's not, I think preparation, it requires mammoth preparation. The paper sounds easy, but implication of that paper may not be easy. Because today, if you look at open APIs, we are in a digital world where we connect through open APIs. Now, you giving consumer any open APIs, that is treated as a algos as per the new paper. Now, if that has to be controlled, it means the end user who's, where he's using his open APIs, I need to get the approval done for that. So practically getting all the algos approved through broker, that's a tedious task. Probably, it needs to be limited. Where and which players you are giving to, and obviously it will consolidate the market, but it will also give a fair opportunity to retail investors because they end up using their open APIs to authorize and unauthorized places where end up making losses, because the SEBI concern was one of them, was there are a lot of promising returns were promoted by algo providers. So I think that will come down. But here, I think role of a lot more clarity is required as far as role of broker, role of algo provider, and the risk management is concerned. But it's not easy to implement. The kind of bandwidth is required, and maintaining compliance on round the clock will be tedious task for brokers to manage.
Okay, Prabhakar, will it lead to a significant increase in compliance costs, which will sort of eat into bottom line?
See, I mean, the way, I mean, the paper says that, registration is required for all algo provider. Broker oversight will be there. So broker will be the principal and the algo provider will be the agent. So the implication of something going wrong, would be on the broker.
Correct.
This ensures that, I mean, because the tech algo has gone such big thing, if the registration will ensure that we'll not have algos which will disrupt the market in a big way. Now, retail getting access to algo is simply awesome. And that too, because the algo provider need to not document everything. They need to make their strategy like upfront and, convince the retail. And also people who got habituated of trading during COVID time or work from home, they have a big problem nowadays because in working from office or like continuous meeting, they are not able to track their position as such. So algo trading is like a, trading with seat belts on, which will help retail in a big way. And also it will ensure that the market even depth will go up, because the kind of algo trading institution go for and the kind of algo trading retail will go for, there'll be variation in that. So to my mind, you talked about compliance cost as such. Compliance cost will be there definitely, but not so much. From what I heard, there could be templates of algo, and the minor changes within the algo can be done without going back to exchanges again and again. So it will go up, but I mean, it will be compensated by higher revenues, higher retail participation.
Okay. Another thing I think I should ask Ujjwal is this, discontinuing this referral program, which is, a huge customer acquisition strategy for a lot of discount brokers, particularly. How do you think customer acquisition costs, do they go up significantly because of this disallowance? Are there alternate strategies that you, especially because you are also a new entrant, relatively new entrant, how do you look at it?
See, the referral changes that has come, I mean, where they're trying to say that where the referral program included a trade incentive, right? Which comes in the worlds of AP.
Yeah.
So the whole lines got blurred because the modern social media actually allowed customer to customer in a AP style, which they have fixed, which is a great thing. But I think there's a representation through ISF going to SEBI with all the industry bodies, at least the standard referral program, which in a digital world where you pay a standard referral incentive, which is not linked to trading, but just opening the account, that may or may not continue. But I think there's a representation gone to SEBI. It's a work in progress through ISF. I think that would allow standard referral programs, which is not linked to trading. I think that is somewhere it should go. Even if it doesn't go, I think from an acquisition standpoint, I think typically.
No, how is it different? Just explain to me, how is the standard referral
So
program
basically,
different
when
from
you
what?
open an account with a broker, let's say I referred you and you open an account, you get some incentive, right? In like typically the problematic part of referral was that you continue to make like shared brokerage
Correct,
income,
correct.
and a lot of these customers used to actually do more like a very mass market campaigns as a consumer to get more customers, and that lead to a situation where you are actually a systematically important person for a broker because you're bringing so many accounts, which is typically where you should be governed under AP. That is where SEBI has fixed it, by saying that no if you are doing referral where trading is linked as an incentive, you should come under AP governance, which is a great place. But typically on a customer to customer, if you refer a customer and you get a one-time incentive, that's like a very standard modern consumer tech
But
practice.
that's
Right?
hardly an alternative for the way referral programs were used to.
I think it will converge to that new normal, right? That is where it will go. And obviously, apart from that, the typical acquisition through digital marketing, performance marketing continues, where SEBI has allowed in a typically how you do to grow a market by doing performance ads. So that continues. There is no challenge on that.
Okay.
Larger concern was so AP authorized partners was an established business model, and which is regulated one. The entire problem happened when the industry moved to the referral partner.
Correct.
So there's a referral, which is a customers to customer referral, and there's authorized partner. There's nothing in between. Off lately in last 3-4 years, this entire referral partners got emerged, where the model was as mirror as authorized partner, but without the regulatory preview. Right. Where you end up sharing, incentives as well as the trading linked incentive, which is brokerage sharing as well as account opening charges. So which was kind of unauthorized in a way, accidentally or unfortunately happened, which the larger cups happened on that way. So all entities which was acquiring accounts, leveraging referral partners, they may got maybe some impact. But authorized partners, they have given better clarity, so which should continue to grow. And the customer level, as Ujjwal mentioned, ISF is already represented, and one-time incentives, I think regulator also doesn't have any concern there.
Fair enough. How about progress on ASBA, essentially, to introduce those 3-in-1 accounts? That again is feared to eat into float income, right? So what is the progress? When are we getting there?
So, of course, the regulation now very clear that QSP or the large brokers have to implement this by 1st February.
Correct.
And this is underway since very long time now.
Is everyone in the industry ready for this implementation by February 1st?
For especially HDFC bank-based broker within HDFC, we were already providing the services in a way of hold release transfer. So in the same way, it is ASBA facility for our customer. There is no change. So practically, yes, for other brokers, they need to implement, I think, but most of them I see in progressing in the same direction.
Fair enough. Sorry.
Yeah, so we are on track for 1st February to offer that. Of course, we have a bank break Trinity account where it is directly linked to our parent bank. But I think the regulation is moving toward the philosophy of regulator that let brokerage house make money out of brokerage that you charge to the customer and not through all other different means, like option rebate, which was one of the things that has come in as a regulation. So I think the idea is that you charge transparently what is the brokerage, let customer know what is the brokerage that he is paying to the broker, and everything else should not be charged in a disguised manner. So I think that is overall improving the transparency in the system, and that is in the benefit of the customer. Today, the way you are able to apply IPO without having your money being moved out of your bank account, and IPO has like flourished like anything. Similarly, on the secondary market, if you are able to trade where money is still lying in your bank account without moving to your broker, I think that will further scale up the growth of this market, because a lot of investors are still not comfortable transferring the money or taking trouble of transferring the money. They just want to buy the stock where money is lying in your bank account. Only when the trade is happened, it should get settled. So I think this is a very innovative idea, and I am very sure nowhere in the world this kind of technology and product is available. So I think this is one more innovation, if I may say, which is again, put on the UPI framework by India, which is one of the unique in the world today.
Fair enough. What does all this mean, Prabhakar? I mean, you are amongst the top brokers in the country. Um, is there a big shift you see in the way broking houses emerge out of this? Will there be more non-brokers than brokers? Will from discount broking, does the word discount get dropped now?
See, I always believe there was nothing on discount. Actually, it was a fintech brokerage house. That's what we became. And very clearly, I mean, all the revenue streams which were available allowed us to kind of increase the equity participation on the delivery side, and of course, like charge FNO that to a fixed amount, unlike traditional players and banks, and that really helped. Now, the bigger thing that I see is that all of us are moving towards offering various kind of other services. We are getting into direct mutual fund distribution, insurance distribution, lending, and other things also in the pipeline. So broking is just one product which can attract large number of customers on the platform if the platform is very reliable and robust. But eventually, it's the managing the wealth, allowing a customer to invest intelligently. I mean, that's the goal of all platforms. So I wouldn't say broker or non-broker, discount broker as such.
Sandeep, are your growth aspirations toned down because of the way the regulatory environment is panning out?
Certainly not. I think these regulations, this is not the first of kind regulation has come ever. We have gone through peak margins and many, regulations in past. And every time I've seen the participation has gone up, growth has gone up, newer investors are coming to the industry. So from no way our growth aspirations have come down. And we continue to aspire more. Recently, last year, we also launched our discount broking platform, HDFC Sky, and we continue to serve our HNI customers. In fact, we are expanding. Rather, in a way, I would say, we are becoming full stack from discount broking to full service broker to investment advisory to family offices. So thereby we can cater all sort of investor class.
Does the word discount go away now? Like all things discount vanished in India. Discount airline vanished. So is it time for discount broking to vanish now?
No, I think it is not right thing to say so, but yes, discounting, discounted price will move to the right pricing. I think you will have a right pricing for the product. And you asked about whether discount broker is a category. I think what Prabhakar mentioned is correct. It is a digital broker or a fintech broker who started with discounting some part of the market and started charging on some part of the market and relying on scale to get the profitability. Finally, all organizations are for-profit organizations. Whether you get income out of scale or out of personalized services. Like at Kotak, we have got our branch-based brokerage, which was a traditional bank-based brokerage house. And as Sandeep said, we also have launched Kotak Neo digital platform. Now, you are running digital platform. Does that mean are you running discount brokerage? You can have some part of the market or product which is discounted. So I think discounts are here to stay. There are multiple players and lot many are emerging. So you will have innovation coming in, innovative product coming in, and some of the discounting will continue. Some part of the discounting will go away and move towards right pricing.
Sure. Ujjwal, tell me one big risk that you see to this business over the next 2 to 3 years and the opportunity as you see it.
Yeah, see, the risk always is around. I think market cyclicality always impacts this business. Like the with Trump coming in US markets look attractive. So next 1 year is gonna be slightly tapered from an Indian context. I mean, we were discussing offline how Indian equities market might not be as vibrant for next 1 year in terms of expectations, right? So the market cyclicality continues to be a risk for, and this is part of this business, and also the way regulators change, like evolve basis customer behaviors, they bring changes which impacts in the shorter term. So these two continues, but if you're building with the long run, these are part of your like risk management or business strategy, right? So that's one part. So from an opportunity, I think, see, opportunity wise, I think this whole what everybody was saying, and I mean, you need to see where bank brokers are also launching discount broking. So there's largely any discount broking or bank based broking. It's broking largely, and I think it's largely mostly as Sandeep was telling also, it's like between DIY or RM, right? And a lot of these brokers who charge a lot of like a higher brokerage, they say that we have an RM, we assist you, we guide you. I think somewhere discount broking now is elevates to that DIY broking where you are able to provide value at scale also. It was all about affordability and convenience at scale for last 5-7 years to bring Indian markets to the population scale. I think the next opportunity is to bring value or intelligence at the hands of investors and traders in a DIY model. I think that's an opportunity. We have been working since 2016. We launched building the intelligence layer, then obviously launching the stockbroking business for the PhonePe group, Share Market, where we are taking that long-term opportunity bet of how do we provide now value at scale, like, and that's a very interesting place to be, where you can, if you are able to serve with right consumer experiences, research, data insights on a consumer platform in a way where customers' behavior on a very implicit basis can change in the right way, nudge them in the right way, and provide value to their portfolio and through their trading. I think that's an exciting opportunity to solve.
Sure, that's all we have time for. Thank you, gentlemen, for joining us. The message is long term is we are going up. Thank you so much.
Thank you.
Thank you, Mahalakshmi. Thank you, speakers, for that. Now, any conversation on fintechs would be incomplete if we don't touch upon the topic of payments and UPI. An integral part of our lives, UPI today is omnipresent. It's not long before we see 1 billion transactions a day. But what's next for UPI? How will the market share battle pan out? To discuss all this and more and really decode the next phase of payments, please welcome on stage our next set of speakers. Ritesh Shukla, the CEO of NPCI International Payments Limited, M.N. Srinivasu, co-founder BillDesk, Sharad Bulusu, Director of Product Management at Google Pay, and Riju Datta, co-founder Cashfree Payments, and I will be moderating this discussion. Sharad, actually, I have to ask you this question first. When is this circular coming from NPCI on that 30% cap? At least the media is waiting with bated breath. Are you also waiting? When can we expect it? Did you happen to ask Ritesh what NPCI has in mind?
You should ask them, no?
But what are you hoping for?
Just clarity. I think some of these things are not easy. I appreciate the difficulty that anyone who's in the business of trying to regulate something will have. But as long as there's clarity, we'll work through it. And we'll work through a lot of change as an ecosystem generally.
Right. Shri, if I can come to you in terms of the next phase of growth for digital payments, where is that going to come from? And Riju, you can chip in here as well in terms of the impact for payment gateways. Because I remember last year when we spoke to you, you said, you know, payment gateways sort of the graveyard where fintechs come to die because of the lack of monetization opportunities. But has that improved?
Just to correct you so that I look a bit more like visionary, I made a statement 5 years ago. Right? Last year it was already playing out. No, I think it depends. I think what one needs to perhaps debate, maybe not in this session, is what does growth mean? That apart, I think payment growth, if measured by volume and metrics, is purely going to come in terms of number of small value transactions, number of credit transactions as an overlay to an underlying debit transaction. Those are two areas of growth. Pretty much a no-brainer that this will, a majority, if not a dominant portion of them, will come on the rails of UPI.
Right.
The one difference that could be in terms of the next 3 years compared to the past 3 is a lot more transaction will come from what we typically call the tier 3, tier 4, tier 5 cities.
The Bharat, the so-called Bharat 2, Bharat.
Yeah, many of them will come from those markets. I mean, a large part of the growth will come from those markets.
Riju?
Yeah, I mean, maybe if we can speak at a moonshot level, I think I'll speak about looking at UPI more not as a local domestic payment mode, but as a global payment network, which means, you know, allowing other networks also to kind of transact on UPI. And I think that can unlock a large share of growth, which would be a lot of cross-border payments, right? Foreign people coming to India. So I think when we look to take UPI global, I think that global probably starts at home, right? And this is probably a moonshot, like not UPI 3, maybe UPI 4, but yeah, that's something that can unlock growth over and beyond.
Right. Since you mentioned UPI going global, we have Ritesh on stage who leads the NPCI International business. Ritesh, this has been a recurrent theme this year. I think Nalin also mentioned it in the beginning that foreign delegates these days, one of the wow factors for them is to actually sample digital payment transactions, and you've expanded your footprint worldwide. What can we expect more on that front? Is that going to be the next big trigger towards achieving 1 billion transactions a day? What plans do you have as far as taking UPI global is concerned?
Thank you for the opportunity. And before I make any of the comments, I just want to make a disclaimer. I'm representing only NPCI International.
Right.
I'm not talking about NPCI in India. So coming to your question, as an organization, we are focused on two vectors. One is how we can collaborate with other countries to help them create their sovereign payment ecosystem. So which is where specifically for instant payments, we have a partnership going on with Peru, we have partnership going on with Namibia, we have partnership going on with Trinidad and Tobago. So these are three in the instant payment domain. Similarly, we are working with UAE and Mauritius for helping them create their own card scheme like RuPay. So we are talking on the infra level, we are helping other countries to be sovereign in their domestic payment needs, right? Once these systems are ready and thriving, then of course we will look at connecting them with India to serve cross-border flows on a bilateral basis between these two markets. So that's the first vector. The second is interoperability. We are currently live in 7 countries where a UPI consumer with UPI, one of any of the UPI apps from India can go to these markets, scan the QR codes and make payments. For example, Nepal, Sri Lanka, UAE, Singapore, Mauritius, Bhutan and likes. And we are now in the markets that we are live, we are now looking at building traction. That would mean creating awareness on two sides. One is in the market. When you land up in these markets, you should be able to see that if the merchant that you're going to, for example, you go to Tanishq showroom in UAE, Dubai, then when you go to the Tanishq showroom, you buy jewelry, and then you should be able to see that UPI will work here. Otherwise, it's a best kept secret.
Yeah.
So that's on the merchant side. Similarly, on the India side, we have actually 3-pronged strategy. We are working with banks in India to be able to educate the consumers that when they travel to these markets, it will work. We are also working with fintechs, like PhonePe, Google Pay, and others, and Beam, for kind of creating a notification as in when they land in the foreign markets. We are also then looking at occupying prime real estate at the 6 airports. We are currently live on the international terminals, wherein people, when they are taking flights internationally, they see branding and they can figure out where all it will work. So that's what we are looking at doing. And in times to come, we'll go live in many other corridors which are of relevance to Indian tourists. For example, you can take Qatar, Thailand, markets that
Southeast
are
Asia.
Southeast Asia. Yeah.
So 7 countries now where UPI is live. This is a made in India product that's going global. How many more countries in 2025? Do you have a number in mind?
So, while NPCI, and this is what I'm only going to talk about, NPCI works at a neck break speed. There are partners who are outside India. They have their own way of, completing a project and all. So we are hopeful of going live with at least 3-4 more countries. But if projects, are completed on time, maybe 6 countries. That's what we are looking at. And why not? Today, I think as per a report by economists, about 30 million Indians traveled in 2023. And they're saying by 2040, 90 million Indians will start traveling outside India. And that's a huge number. Chinese tourists at peak were 104 million traveling every year.
Right.
So we are going to be very close to that. And you look at all the other signs, I think 2014, we had 70 airports with commercial flights. Now we have about 150 airports with commercial flights. A lot of our airliners have made bulk order for planes. So there's a lot of foreign tourism or outbound tourism that's going to happen. And we are creating network to be able to serve these consumers when they travel outside.
Right. Sharad, 2024 has also been an interesting a tipping point as far as the number of new UPI apps are concerned, right? I think there have been at least 20 new UPI apps, if I got that number wrong, correct. So what's driving this heightened interest? And you are seeing some traction. Of course, the base is low, but Navi and Super Money have risen to 4th and 6th places. Cred is in the room. Kunal's in the room. Cred UPI is also doing incredibly well. Are we going to see these newer players taking more share away from PhonePe, Google Pay? Do they ultimately hit a ceiling? How is this going to work out? And how's it been for you competing with these whole new range of apps?
In some ways, this is a fun new phase, right? The way I see it is, do we expect them to grow? Yes. My hope is that we are not just growing within the same pie that exists today and talking about who's taking share away from whom, but instead we're talking about how the entire UPI ecosystem grows, right? For a country of our size, we are still not quite as large as we ought to be. If you think of the entire UPI ecosystem, like 350 million odd users, right, who are actively using it every month. For a country of this size, that number ought to be twice that. If that growth is going to come, there's ample room for many more players to grow. I also think there's ample room for people to innovate with specific customer segments, with specific use cases, with specific ways of doing things. I think ultimately, these products don't appeal to people simply because they use a certain protocol or they enable a certain piece of functionality. They also appeal to people because they do it in a certain way, right? So when I look at the app that we have created versus the one that PhonePe has created or Cred or anyone else, each one has chosen a different design. Each one has chosen a different approach to make this appeal to users. So what I'm looking at here is more players coming in is great because potentially they're looking at different user segments, different use cases. So that allows the entire market to grow.
Expand the market. It won't be just
exactly. And I think that's critical for a market of this size. We need to see that. I mean, we've been talking about how India is going to become a bigger economy, play at the forefront of a lot of things. I think if you take the 50,000-foot view, what matters is that real incomes in the country have to go up. People should have more money to spend on more things. That is when payments will grow.
How many UPI apps do you have on your phone?
I have quite a few. I must have like 12 or 13 of them.
12 or 13?
Yeah.
You're obviously going to say you use Google Pay the most.
Of course, I have to. I look at it multiple times a day. I also look at it even when I'm not making a payment because that's the app we build.
How many do you have?
Couple of them.
Couple of them. Should I ask you which one so you don't want to get it?
I'm actually indifferent to which one I use in the sense that, not because some of the players in the room, but I think fairly commoditized as an experience. Going forward, one will use his apps not because the functionality of UPI, that's going to be the basic hook that will anyway exist, right? You don't need redundancy in this. I mean, it's not like an option. You're going to debit your A bank account. There is a way UPI will work. If your bank is down, it doesn't matter which app you're using. And all apps have reached a level of quality that the distinction between the performance and app is not going to be distinguishable to the regular consumer, right? I mean, so it really doesn't matter which 2, 3 you have, which I assume is one of the key premise on which Beam is going to see a huge launch. There is an ability, and to your question, why are 30 players doing it? I have actually a more interesting question that if Sharath were to answer anybody else. You have the current 3, 4, 5 players who talk of the unviability of the economic model around it. But at the same time, you have an India and a Bharat where you have 30 new entrants who obviously know something more, a secret sauce where they believe it makes sense. So I think there is a way this will evolve. It is not centric to a way of thinking or of what one believes or not. And to your question of market shares, the right way also to perhaps look at is the count doesn't matter, your shares will matter at some point. And all tech world, all innovation, rarely have we seen distributed markets. I mean, while it's a good thing to aspire for, you'll be hard put to find examples in any tech innovation.
It's usually a winner takes all.
Or 2, 3. I mean, I could come up with a new browser. Sharath could start his own company called new browser, but it's a question of what market share will it take. That's the reality. It's got nothing to do with UPI or India. I'm just saying that's the way world works for any tech innovation. First, more advantageous scale innovation are very, very difficult for somebody to kind of break at scale, unless there is I wouldn't call it a disruption, I'll call it an intervention if it happens. Disruption is when private players do it, intervention is when policymakers do it, right? That's not, policymakers don't disrupt, they intervene. If interventions happen, market shares can change, right? But on a normal market course, in general for a product, I'm saying not UPI, if anything else is tough.
Right. Riju, how has UPI changed the game as far as payment gateways are concerned? Because we're seeing millions of new merchants coming online, and payment gateways have also innovated on what they offer beyond payments, right? Some of them have started offering insurance and so on. So, has it also has the role of PGs also increased as a gatekeeper, which does KYC for millions of new merchants?
Sure. Yeah, I think the role has changed in two ways. One, I think with UPI, the way in which fraud happened changed. So I think we had to adapt to fraud the way it happens on UPI. So which was very different from, like cards or chargebacks, whereas UPI saw on QR codes or collect flows saw a very different kind of fraud. And the second part, as you rightly mentioned, right, it's the kind of, in the long run, I think the kind of workflows you build around the core payment processing, I think that's what helps you stay relevant. So for instance, now in e-commerce, I think you will hear a lot about one-click checkout that has become relevant, where instead of the checkout page, you are focused on showing the right payment method, saving the addresses, running discounts, running offers, right? So those kind of features for e-commerce is what is relevant today. Likewise, you will have something else for fee collection, hotel booking. So I think we are now working a lot on those industry specific workflows over and above the basic payment processing. And fraud, of course, is something that we have to adapt. And I think we've done a lot of work in the last couple of years to adapt to fraud. Yeah.
Right. Sharad, in the last few years, we have seen many UPI apps, but somehow it's sort of become, a comfortable duopoly between PhonePe and Google Pay, right? I think PhonePe has 47%, Google Pay has 37%, and you could call it network effects. I mean, WhatsApp tried its hand, but, it couldn't really take off the way people expected it to. Do you think Bheem will be the game changer? How worried are you about Bheem?
Like I said, the game in some ways is still early enough that the worry is not about someone taking away what you have. I think the game to play is how do you expand the market and get bigger. So what I worry about day to day is, are there people whose needs we are not able to serve today? Are there ways that we can serve them tomorrow? Are there users who are excluded today that we can figure out a way to include tomorrow? And if we do that, then I worry less about, is someone snapping at my heels, and worrying more about, am I building the right thing for the consumer? And I think this is true, right? This ranges from maybe something like UPI Circle, which is more real and nearly here in terms of taking off, which enables one set of users to come on board the UPI bandwagon. And then there's other work we're doing where we go off and have researchers interviewing people in rural locations, trying to understand what will it take to get more rural women using UPI.
Right.
That might be a longer arc, right? Because that's not just technological change, that is social change, economic change, a lot of other stuff. So I think the way I see it is, it's less about whether one app or the other is fighting. And in this kind of early stage, the other thing that you'll also see is when markets double in size, triple in size, the incumbents that start, many of them don't even survive at that stage. Right? This has happened in retail, this has happened in technology, it's happened in a number of places. So I think the only way to stay relevant is not to worry as much about what somebody else is doing. What they're doing is their thing to worry about. Our thing is to worry about, are we doing the right thing for our customers?
Right. Ritesh, in terms of the use cases itself, how has it been different internationally? People who use UPI, is it Indians traveling? Are you seeing what kind of usage behavior or patterns are you seeing as far as international business is concerned?
So we are basically targeting two use cases, P2P and P2M. P2P is we are actually exploring two ways of doing P2P. One is bilateral, the other is multilateral. Bilateral meaning we have connected UPI in India with PayNow in Singapore, and we are talking to many. There's one discussion which is in public domain is with ANI. ANI is UAE's fast payment system like UPI. So imagine if we are able to connect ANI and UPI, we get about 18 to $20 billion every year from UAE. Just imagine people will be able to use their bank account and money will be here in seconds. So that's bilateral route. We are also ready with another country, which launch will happen in a month or so. So that's the bilateral part of it. The other is multilateral, wherein initiatives like Nexus. So there's a Nexus by BIS initiative that is in pipeline. 5 countries have signed up for it. Reserve Bank of India is one such signatory. So we are exploring that model, which is more like a hub and spoke model. So you participate in it, and any country who is part of it, you can cater to P2P flows. So that's on the remittance part of it. On P2M, the countries that I mentioned, currently we are live as for outbound travelers from India. But having said that, we are also working on inbound, because we also want to help our small businesses to be able to sell more to the foreign tourists. So that's something that's in pipeline. And very soon, people from Mauritius, Nepal, when they visit India, they will be able to transact at at merchants who have enabled for cross-border payments, because that's and similarly we are looking at many other markets creating these connections in a reciprocal way.
Right. Vasu, we've also seen many people, launch credit related products, right? Will that be the key to cracking monetization? Because that's been a bugbear.
I don't know if that'll be key to cracking monetization. It's simply that it will carry a revenue line. When I'm distinguishing between monetization, profitability, and kind of creating revenue. Credit by definition is a lender involved. It's hard put to imagine lending going free, right? So to that extent, there's a monetization. But from a use case on the rails, again, it might, to my mind, be an easily monetizable product only when there is scale. And therefore, technically, in a market, if you had, let's say, 50 players with X amount of average share, there is one way it will monetize. In a different kind of market, monetization play out in favor for some versus not. That's what it would do. Having said that, credit by itself will come with that revenue line, and it will come with the to be solved friction, which will be solved, because I think the pull factor of the credit will be strong enough to overcome friction. But those are two things to be solved for there.
Right. Unlike cards, UPI, because of the sheer volume, also tends to have higher failure rates. How are payment gateways optimizing or solving for this, especially for merchants?
Yes, I think the idea is to be vertically integrated and kind of connect the merchant directly to the network. So in our case, we built our own acquiring switch, and that helps us process, in upwards of 12,000 transactions per second. And, and you end up avoiding issues like, let's say, during a concert ticket booking, your payments don't go through. So that is how we handle the scale of 10,000 transactions per second. But apart from that, I think UPI, to their credit, have solved through intent flows, like the other issues that we initially saw, right, around success rate. So I think when we started, UPI was around 60-65%, and today I think we see it around 86% odd, which is pretty close to cards, right? So I think we have improved there, but finally, what's the solution for an aggregator? You have to vertically integrate and build a switch. I think that's the idea.
Right. Last 30 seconds, Sharad, what's your biggest wish for 2024 as far as from the regulatory side is concerned? I know you said clarity, but you can elaborate on that.
Well, 2024 is almost over.
2025.
So I think if we were to think about it from regulatorily, at least from my point of view, the way I see it is, look, regulation will take its path based on how products and services in the market are evolving, because the job of the regulator is multifold: protect the consumer. I think there is some work that's happening in that space where we're expecting to see how rules like the formalization of DPDP will work out in India. That will be a big change, not just for
DPDP
payment
rules
apps, but
is sort of widely awaited.
yeah, not just for payment apps, but across the board for anything that touches people's data, etc. So I think that is one thing. But what it also does at the same time is it resolves a lot of things that are otherwise left uncertain. So in that sense, it also gives us confidence to go ahead and say, okay, now we know where there is clarity. The value of the clarity is that we can move forward with far greater speed and far greater certainty. Becomes a lot easier to justify where we invest and what we build. I think similarly, if I were looking at the acquiring side, I think there are rules related to payment aggregators that are about to be notified. I think I'd look at that. I think similarly in a number of places also, there have been rules that have been notified that have been implemented. But I think now as the industry scales, I'm sure there will be feedback on them. There'll be back and forth on how they get improved and tweaked, right? Take an example of something like KYC rules that existed for a while and then got augmented by saying, hey, now you can do video-based stuff. I think there have been references in the past in the finance minister's statements as part of the budget, as well as elsewhere, to do more risk-based diligence. Now, what shape that takes in a country where there are still concerns about social engineering, the possibility of fraud, etc., we'll have to think about. But I think those are the main areas that I look at, like things related to data, things related to merchants, and then how do we onboard customers?
Right. Final question to Vasu and Riju. This has also been the year of IPOs. When can we expect BillDesk's IPO?
You asked me this even last year. No, I think it's from our perspective, it's not about timing a market. So I think IPOs when it would make sense for us. It's made sense for many years now, and it will continue to make sense. I think there never been a pressure or urgency around it. So we'll kind of play it by the ear to see whenever we need to do it.
Right.
Yeah, I think we're focusing on growing the business before we think about an IPO. So no
No
thoughts
rush
as
to
of
hit
now.
the last. Great. On that note, thank you very much for joining us at Moneycontrol. Thank you.
Thank you.
Thank you.
Right. Thank you for that. Next up, from the markets to payments to the digital lending space, let's unpack how digital lending can drive economic growth. To discuss this in detail, I would like to invite my colleague Naina Sood from Moneycontrol, and she will be in conversation with Ranveer Singh, the founder and CEO of Kisht and Ring. Ranveer, come up on stage, please.
And we welcome to Moneycontrol Fintech Conclave. Great to have you with us here. Let's dive in.
Pleasure is all mine.
It's been quite a strong year for Kisht. Let me read out some numbers here. You marked your FY24 with a disbursement of about 18,572 crore, which is like a 54% growth. Your assets under management touched 3,600 crore. You're sitting on a comfortable net worth of about 805 crores. So congratulations on those milestones.
Thank you.
But having said that, it's been quite a year for unsecured lenders, with the RBI tightening news around unsecured lending. Tell us, how has it been for Kisht? How did you navigate these changes? What did you do right to touch these numbers?
First of all, thanks a lot for having me here. It's truly a pleasure and privilege to be here. Indeed, the last 12 months have been tumultuous, to say the least. But we are one of the few players who have not only come out unscathed, but also have grown miles and bounds in this period. I think there are two things which is rather mentionable if we talk about the last 12 to 18 months. First one is the entire, regulation, RBI coming with many pronouncements, some actions, so on and so forth. They have been a guardian of honest and fair play. They have been, I would say, shown an unshakable resolve when it comes to creating a sense of trust and stability in the market, and they should be credited for that. I think some of the moves, I would say, are not discrete tinkering in the market, but also scrupulously researched, and then they have come up with. I think what we tend to lose in this whole muddle of information is there have been many positives as well. And let me lay out few positives, which perhaps will give a good indication of the market before I come to what is the other thing which has contributed. Some of you may have come across that RBI has appointed FACE. We are one of the founders of FACE as the self-regulatory organization as far as digital lending is concerned. I think the way, and we do have the benefit of interacting with RBI, not only, by reading their pronouncement, but also having bilateral conversation through FACE directly, so on and so forth. And I think one thing is very clear, that as much as RBI wants to promote innovation, they want to have new models coming in, people who are otherwise not getting credit, they getting credit, and so on and so forth. They also want it to be done in a frameworkish manner, where people are not flouting the liberties given to some of the lending players to go out and access a customer base which otherwise was not accessible. I think for us, we have been, I would say, there may be many, one would concede that there are many challenges in the business. But if you have built the business right from day one with a very strong eye on compliance and not seeing compliance as an afterthought, I think what last 1 year or 1.5 years have proved, that the benefits could be massive of that, because the credibility that you build with regulator, otherwise what you build with some of your partners can go a long way in basically, building the business. So that's one thing which has been different. But I would say, all in all, for the industry, there are many things which have been positive. Even the FLDG norm, right, which came almost around a year back or so. I remember the day it came, there was newspaper article filled with, oh, now 5% FLDG, people will not get, the risk in unsecured lending is much more than 5%. But I think it has brought a sense of stability and certainty in terms of, doing co-lending partnership. I have been a beneficiary of such a system because now not a fortnight goes by when there is a large partner wanting to partner with us because they want to strike a deal which can help them grow the business, and I get capital. So I would say it's a little bit of a mixed story, but regulation has been the mainstay and it will remain at least for the next 1 year as well. I think the second thing to be said about what has happened in the last 12 to 18 months, and I'm sure it may be true for many people who operate in lending business, there is one question which I can never evade, and it happens almost every day, if not every alternate day. They ask me a question with a straight face: is your portfolio holding up? And it is one of those things, when I look at my portfolio, it is not only holding up, but it is doing well. But just because the question is asked so many times, you start questioning, whether, if you are somebody who is keeping calm when everybody else is not, perhaps you have not understood the gravity of the situation. But I think to be more serious on this aspect, there are aspects of lending which, if you avoid, for example, over leverage has been building up not from today, but for the last, I would say, 2 years. We as practitioner doesn't have to hear it from RBI or from the governor when he makes his announcement. There are a bunch of moves that we have done, which of course had come at a cost of doing business because our disbursement we had to reduce. But one thing we were very clear, that we don't want to get into a territory where we may be funding somebody who is already over leveraged and perhaps will have implications on the risk later on. So I would say two things: just having a high reliance on high focus on compliance, and second, just continuing to believe on your underwriting model, using all the data and ensuring some of the over leverage and some of the other risky lending you may want to avoid. So I think those two things have kept us in a good stead.
So, Ranveer, in line of these challenges, we now sort of seeing a shift towards secured lending. I think you also discontinued your short-term purchase finance product, and now you're moving towards a longer tenure, higher loans. So, how do you see that faring out? Because secured lending also comes with its own set of challenges in terms of collateral verification, the physical branches. So, how do you see that transition happening? I don't want to use the word pivot, but how do you see that diversification happening?
So the reason we got into secure lending was very simple. In my customer base, every month, people end up taking anywhere between 1,500 to 1,800 crore of loan against property. And this is my customers who, and when I say my customer, they are not somebody who have downloaded my app or just registered themselves. They've actually taken loan from me and they're due amount to pay. Unfortunately, I'm not able to cater to that segment. The reason I'm not able to cater to that segment because I don't have the product. And even if I have the product, I don't have the comfort of capital. So it's one of those evolution which can only happen once you have become large enough. There is a great deal of credibility you have built with your lenders and providers of capital so that you can offer this product. And that was our segue into our rationale for going and building this secured product. It is one of the many products in the long journey that we will follow in building one of the most respectable financial services that we will do. Rightly put, it is not digital lending. Unfortunately, rather unwittingly, it can be admitted that in India, you can't do fully digital business for secured piece. But I think with every passing day, it is changing. I think the vast advances of technology have not been fully explored when it comes to secured lending. What we saw 5-6 years back on unsecured lending, I would say with some degree of conviction that we are at the turn and cusp of seeing a bigger thing on the secured side, but not the plain vanilla garden variety secured, just go there and do the lending over a period of 20 days and give the loan after like 3 weeks into the customer's account. What we believe is in this day and age, you cannot take that long. We still are not at the stage, but the idea of we doing secured lending is to be able to take all the learnings from unsecured and yet take the property so that it is tagged as secured and are able to disperse in no more than 72 hours. And when I say disburse, it's not about giving some in-principle sanction letter or something, right from lock, stock, barrel, transferring the money into the account. And in that sense, it is a little bit of a disruption. Unfortunately, because of the collateralization involved in secured business, you still require branches. So we'll continue to follow the branch-based model. But the idea is to do it in a manner where we are using all the greatest and latest when it comes to data and technology to build a scale there.
Maybe small scale entrepreneurs in tier 2 and beyond areas, and SME loans is a hotspot right now. How big is the opportunity there, and how are you looking at it?
Yeah, so the opportunity is massive there, needless to say. And if I see at one level, one of the dilemmas fintechs like us face is there is no way I can match the pricing of a bank because their cost of fund is a puny one compared to mine. Why I'm talking about this in context to self-employed and SME segment, because, and not to be critical of any bank or any this thing, I think they've done a great job. But the old ways of doing business is rather, I would say, one of the recurrent ironies, I would say, of the financial, that nobody knows how to underwrite somebody who has uneven cash flows, where there are crests and troughs. Not that we understand it, but at least we have used data to a very large extent, which has allowed us to underwrite some of these customers. One of the myths which exists, and let me share this with the audience, that salaried customer is always better than self-employed. If you go and talk to any person who has been in the street for long, he would never ever question that dictum. In my book, always take any loan given under any circumstances, any sliver, any day and time. The self-employed customers has performed better than the salaried one, and it has made me pull my hair why that is the case. Because the thing is very simple. With salaried people, you can never be competitive. A salaried guy, there are a whole barrage of banks, then larger NBFCs who are ready to underwrite them. It's much easier to underwrite. And one would argue many of the salaried customers who go and take loan from people whose rate will be higher will be a bit of the risky type or the lender of last resort. So coming to this, for us, quote unquote, loan given to SMEs, self-employed or business loan is a very big opportunity. And I think this is where perhaps the true data capability that we have built will blossom to a level where we can truly create a differentiated positioning. Big opportunity.
So how much percentage of your total disbursements to SMEs right now?
So of the total unsecured loan that we do, almost 42% is people having what is called as Udyam certificate or GST. So they are basically the self-employed or the small business guys.
Fantastic. Only last 30 seconds, in the morning you announced Sachin Tendulkar as your brand ambassador and a strategic investor. Is there a backstory here?
Yeah, I think the only backstory is as much as we have done great on many aspects, I think on the areas of branding, perhaps we should have done far more. And it's in a way trying to, cover up for all the things which we didn't do. But more seriously, I don't need to introduce the name and what it stands for. I can't think of anybody else who can bestow a level of trust and credibility across ages when it comes to being a personality which everybody is known. These are almost the similar values that we aspire to stand up to when we are creating what we are creating on the financial services. So we saw that as a great match. We were fortunate enough to tell our story to him, go through rounds of discussions where Mr. Sachin can actually build confidence on that. And we are very, very glad to have our brand ambassador. We only see this as a foretaste of many, many big things to do and build as he is associated with us over a longer period of time.
Fantastic. All the very best, Ranveer, and thank you for all the insights.
Thank you for having me here again. Thanks.
Thank you, Ranveer and Naina. I guess if it's Mumbai, you need a Ranveer in the room and a Sachin in the room, both of which we have in some form. But thank you very much. A bigger round of applause. Let's get the energy going. Moving on to our next session, we are very fortunate to have some of the biggest names in the insurance space with us. Now, given the insurance penetration in India is just 4%, which is far lower compared to developed economies, the potential for growth in this sector is immense. In fact, IRDAI has set a target of ensuring insurance for all by 2047 and has identified InsurTech as one of the key vehicles to drive this growth. According to a report by BCG, India already has more than 150 insurtechs with a cumulative valuation of 13.6 billion. So clearly, the sector is poised for a huge takeoff. To discuss the opportunities and the growth trajectory ahead for the industry, I would call upon stage someone who tracks all things insurance for Moneycontrol, Preeti Kulkarni, and she will be in conversation with the big guns from insurance, R. Doraiswamy, MD, LIC India. Preeti, please come up on stage. R. Doraiswamy, MD, LIC India, Kamlesh Rao, MD and CEO, Aditya Birla Life Insurance, Animesh Das, MD and CEO, ACO General Insurance, Abhay Tibari, MD and CEO, Star Union Daiichi Life Insurance. Huge round of applause for the panel.
Good evening, everyone, and thanks a lot, Chandra, for setting the context. So in this session, we are going to be discussing the opportunities and challenges in the insurance sector, in the insurtech sector rather, with the insurance CEOs. A warm welcome to all of you once again, and thank you for being here. So, sir, if I can start with you. Now, individual insurance agents are the backbone of LIC. And recently, we have seen the launch of Bima Sakhi as well. So, in this context, how do you see the role of technology as an enabler or a disruptor?
As you said, LIC is an organization which has a very big agency force, and it's an agency-driven business organization. We look at technology certainly as an enabler or even a catalyst to further strengthen the agency force and the business to be done through them. That's what we look at it. We would like to enable our agents much more technologically so that they are able to do a much better performance than what they are currently doing.
Okay. And to turn to you, Mr. Rao, now beyond distribution, technology also has a role to play in underwriting. You've been using that tool, besides, of course, in sales and distribution. So could you talk about how it has evolved and what kind of value addition has it made to these functions?
Actually, there are two aspects of underwriting. One is medical, and of course, the other is financial. Insurance industry has huge amount of data. We worked at data. We've been present for the last 20, 25 years. So we've used data of the past. Today, we have a tool where about 50 or 55% of the policies that we issue, no human being looks at the policy. It's a tool which we have jointly developed with an insurtech company. And it gives you a picture of what is right or what is not right. It gives that for 100% of the policies that we source. But amazingly, the accuracy ratio at which it predicts or gives a response, and when we were doing the initial work, the statistical relevance of that model is close to about 90-95%. So it's a great tool. Productivity goes up. Ability to be able to issue a policy much faster actually kind of goes up. And the hands and legs it provides in all areas. I'm saying today there are bots with voice assist that are able to answer customer queries, claims through AI developed models. Typically, two things happen. One is the claims that are supposed to be paid faster gets paid in the fastest possible time. And B, if there is somebody who's trying to fraudulently bring in a claim which is not appropriately right, that also gets detected through AI models. So I think my view is there's a lot of great work done by insurtech companies. If we embrace that together, I think it's going to be good for all the insurance companies in the future.
All right. And Mr. Tiwari, you have been using AI for making investment decisions. So could you talk about how that has worked out, how that has helped your fund managers make better investment decisions, and which are the other areas where you use AI, big data, or other tools?
I think as Kamlesh just mentioned, I think it's largely being used currently on the onboarding side. on the underwriting side and taking decisions. We are getting, the health data is still a bottleneck. We don't get the health data in one place. But, at some stage, I think we'll be able to get proxies for that, and we'll be able to issue policies in real time, actually, immediately customers coming and most of them getting the policies like that. But largely the use has been more on the liability side, I would say underwriting, claims, servicing, uh, product design and all. We still don't have too much of a use case, but gradually we'll see, evolution happening where people will have covers which are very exactly tailor-made for the clients, and, like if he's traveling abroad, maybe the cover can get enhanced. So those kind of, or specifically tailored to that person. If you have, for example, a rural income where it is irregular, you can have a holiday, a premium holiday factored in. So those kind of real time, incorporation of change in the features or the design changes can also start happening. But on the investment side, asset side, it's not only about insurance company, but most of the mutual funds or worldwide also, it is being used to enhance investment performance. It has always been, quant trading has always been very popular. But with the advent of Gen AI, what is happening is that the qualitative data, like the management report or the director's report, that's also being read and understood, and incorporated. The sentiment analysis gets factored. So, and the real-time adaptation of the change in the quantitative numbers also. So earlier it was only quant model which was getting incorporated, but now quantitative model plus the qualitative data is being used to generate better decisions on the investment side.
All right. And coming to you, Animesh, now on the GI side, we have seen a lot of innovations driven by the regulator as well, pay as you drive, and even uh, discounts based on health and so on, wearables and so on. So, in that sense, and also you are tech focused as well. So, and given that there is a lot of focus on Gen Z as a customer segment, do you think that, do you believe that you have an edge over older established but established companies because of your approach?
Yeah, I'll always say yes to it if you'll ask me that way. But no, we need to still do a lot of job. But I think we discussed about payments today. We need to see how insurance is very different from when we think about any other transactions customers do. Usually, insurance is not an individual transaction; it's a asset-based or health-based or individual-based transaction, right? In a way, like the family is taking a decision to buy something. So it's not one quick daily transaction, right? It's very different that way. So, and that may be the reason why the industry was also catching up in terms of the newer trends, right? And still catching up. So I think what ACO has tried doing and is slightly more prepared, like you said, is around, it may take some more time for younger audience. And when I say that, like imagine 10 years down the line, most of the people who will be taking financial decision at home will be people who are born after internet. So their touch points must have evolved a lot, right? Which maybe we are seeing today in telecom world, payment world, right? That's how insurance will get transacted very soon. I believe so that setup like ours is slightly more prepared for that. I'm sure industry will also evolve to that kind of customer segment and those kind of touch points. But we have to see that. Let's see how it happens.
Okay. But I'd like to take the question to life insurers as well. So, sir, now what is your strategy for the younger age groups, Gen Z, and also a lot of newer companies now say that they'll focus more on life, focus more on protection and term insurance and so on, rather than investment come insurance products. So, how do you view this emerging competition?
No, actually, the younger generation, as you say, is currently more focused on protection, no doubt. But insurance has been having the entire spectrum of covers, starting from protection to investment, and now what's also catching up is retirement planning. The business of annuity is also a big potential that people are looking at, and particularly the way the employment market has evolved in the country. Leaving a lot of gig workers, people who are not having any organized kind of a retirement benefit through the employer, and even if they are having one such, not able to continue with the same employer, so that can be secured in a better way. So now the planning for old age or the planning for retirement has also had to be done by the people themselves, and that is where insurance companies have a very big role to play. So you have all the things now, and similarly, the unit link plans is also a great attraction to them. Okay, so that gives them the flexibility to have insurance cover as well as going in for a corpus creation or a wealth creation through using that. So this will be there. It will be undergoing changes, but no doubt the focus will be on protection. And the second important thing is retirement and annuities, with ULIPs and other conventional plans also not going out very
Risk
soon.
of living long. Would you like to add to it? How do you
Actually,
see competition from these newer companies who say that they'll focus more on protection with the use of technology and they'll target Gen Z or the younger generation?
I think it's important because insurance is the first product that is consumed by a younger age guy. Hopefully, is closer to protection. I think insurance industry needs to create more products, simpler ones. We, for one, just now recently, like I said, we converted this whole concept of protection to say everybody buys sum assured, which means if something happens to you, buy a 50 lakhs cover or a 1 crore cover. Normally, when something happens to you, that money goes to the nominee, and he or she does not know what to do with that money. Our other focus group discussion told us that bad advice always goes to people who have lump sum money at different points of time. So we tried seeing whether we can flip it around to say, don't buy sum assured, buy protection of income, which is what some life insurance companies do, to say if something happens to you, protect the income stream that you want of say 10 lakhs per year or 15 lakhs per year for the period of 20 years or 30 years. I think if you get products which will be easily buyable, if I can use that word, and you enable them digitally to make sure it can be bought simplistically through the platform, I think those are things, but we'll need to do more in that area. And I think it's extremely important. But like, Mr. Doraiswamy said, don't forget that younger population is becoming a little lesser, and the older population in the next 10 years or 15 years is going to keep going up. I think by 2035 or 40, it will be about 20% of the entire population. And the only product that you can do for planning your annuity, which is what will happen to you between 60 and 80. We did an interesting concept in that because we trouble our kids to ask them, "Kya bade hoke kya banoge?" We've tried to flip it around to ask the youngsters are asking their parents now, "Kya bude hoke kya banoge?" So because you'll have a life between about 60, because suddenly, you're worried about your car loan and home loan EMI in the 30s, you're worried about your kids' education in the 40s, and suddenly at 50s, you're worried about what will you leave behind, without worrying about what will you do between 60 and 80. Cost of health is going to be higher. You're going to live longer. So I think the ability for us to do as life insurance companies on annuity space is also a very significant product category for which will cater to people who are growing in that category over the next few years' time.
Right, right. Now, on the topic of innovation, in the last few months, Animesh, we have seen that some fintech firms, not necessarily insurtech firms, have faced some regulatory hurdles, be it with SEBI or RBI. So, how has IRDAI's approach been in this regard? How would you rate it? Conservative, accommodating? How has it been?
So I think, first of all, it's not maybe new age firm or fintech firm. It depends on even the traditional setup may also face the same thing. Regulations are set to offer a fair field and push for doing the right things, right? That's how it's defined. So everyone, be it new age setups or older setups, have to honor that. And the right way to kind of approach the regulator is also the right representation, which is helpful for the industry, helpful for the consumers, right? So that should be the dialogues. IIDA, we can take views from others also. I think insurance regulator has been very flexible recently. Specifically has been very flexible in the GI space specifically. The products have been open up. The focus is 100% on the consumers. We are happy about it because that's how we approach any of the opportunity or problem statement. We try to solve it for the consumers, and that's how backward calculation we do about our process and all, right? So those things are very supportive. With industry or regulations opening up a lot in GI space, I think it kind of gives space to innovations, which is what we are looking forward to.
And so now, next year, by April 2025, Bima Sugam is expected to be rolled out. So what kind of opportunities do you foresee? How will it pan out for your agents, customers especially? Will it make the process more transparent? Will the costs come down for insurers as well as policyholders?
Yeah, Bima Sugam is expected to, it's a e-commerce or rather e-marketplace for life insurance or the entire insurance industry. Certainly, it is expected to bring in a lot of transparency, point number one. Two, it's going to provide an opportunity for the distributors as well to be able to sell the insurance products through this. Being a common industry developed platform, it's going to provide that trustworthiness for a person, a customer who would like to buy insurance to do an analysis, to do comparisons, or to come and share his data, or to buy insurance online. So naturally, it is going to help all the stakeholders, including the agents and the distributors who are going to be in the insurance space. Certainly, it is going to, because it is going to become more transparent, it is going to push or nudge the insurance companies to be more transparent themselves, one, to be more innovative, to come up with steps that will create more cost optimization for the customer, end customer certainly, and create that field. Plus, it's also going to provide some kind of the linkages that an insurance company would like to have, so that the whatever you call as the India stack or the data exchanges outside, which will be made use of by the insurance companies in terms of underwriting, better risk management, as well as better pricing. That's one. Also, it gives the customer a common platform. If what we are planning to have is going to happen, if we are going to have a platform on which even claims can be submitted, and claims can be cutting across insurance company can be settled in one go. So that's kind of the transparent and trustworthiness is what the industry is going to, and certainly the customer is going to be beneficial. This is what we are looking forward to.
And Mr. Tiwari, now there's been a lot of talk about mis-selling. The finance minister mentioned, Mr. Panda, the IDI chairman mentioned as well. So again, coming back to AI and other tech tools, how can they help minimize or curb these practices?
It's a very good question. Actually, it's like, see, the insurance as a product can cater to multiple needs, as we discussed earlier, retirement need, protection need. So, if the need is of the customer is for protection, and if we offer something else, then it starts becoming a problem. If the need is for long-term retirement and we start giving, say, a market link product in that context, then it becomes a problem. But standalone, if you see, if the need is protection and we are offering protection, I think that's the most superior product the person can have at that point of time. Similarly, if there is a long-term savings requirement, there is no other financial entity which actually offers that kind of a savings structure. Or if there is a market link structure, if a person is looking for that, then I think the products which life insurance companies are offering, they are the one of the most well priced in that sense now, even the market link products I'm saying. So in all the context, if the needs is properly matched, then it becomes a very good product in that context actually. But the issue is that sometimes we are offering, say for example, if loan customer comes in and we offer a savings product, then it's perhaps becomes a problem or a mismatch. So the current issue is because the liquidity aspect is the only missing piece. If I have to say that what insurance will not be offering is the liquidity over the next 5 years. So if you want to withdraw after 5 years, then it is fine, but within 5 years it is a problem, and that really creates a if there is a mismatch, it really bothers the customer more. In any other product category also, if there is a mismatch, it bothers the customers. But in insurance, if there's a mismatch, because there is no liquidity available, it becomes a big problem. And AI can become a big support in terms of creating that, enabling that matching of the needs, doing the suitability analysis, really suggesting or recommending the product. So that way.
So actually, I think we are running out of time, but if you could just last few words, if you could talk about the future of, if you could start with you, Mr. Tiwari, the future of InsurTech in India and the challenges that you foresee.
See, I mean, there are a lot of things which can happen. I mean, with the quantum computing now, I'm not able to kind of imagine also how it will shape up. But the agentic AI, I feel, will dominate for a long time, the future, because of the advances in the computing speed and all. Now we see that most of it's like a human-like interaction you would start witnessing, in any kind of service request or onboarding journey. You will see the interaction becoming far, far more smoother and real time. So the data being factored for taking decisions on a real-time basis. So everything is now getting incorporated, and I mean, I feel that the nudges to live long and to live healthy, those kind of things will start improving the longevity of the customers also. So once they take a policy, I mean, the companies will be interested in seeing that, they live much longer. And those health nudges and all will become really important and perhaps life-changing. So,
Yeah. Mr. Rao,
No, I'm
thoughts?
only hoping hyper-personalization goes to its extreme. I'm hoping there'll be a time where every individual will see his application form differently, which he understands better. We'll hopefully see a policy document in the language that he understands best. Wordings get demystified. I just think embracing AI, what's happening, is only going to make us more significantly productive, and it'll be a great step for all the insurance companies who do long-term business. Demystify, make it significantly more simpler, and hopefully help the cause of penetration of insurance in the country.
Right, right. So, so coming to you again. So what kind of transformations, tech-led transformations do you see now in the days to come?
It's going to be a good, lot of good practices happening. One, from ensuring the risk of life to the risk prevention or risk mitigation will be the focus. So the insurance companies will be using a lot of technological support, say maybe wearables, maybe monitoring the activities of the customers, maybe asking them to focus on their wellness activities. Maybe they're trying to make people add things like health checkup and stuff like that. So reduction of risk will be the focus. Insurance companies will be better placed to price the products, or maybe able to give a better kind of a yield using all this AI. It's going to be really good.
Final thoughts, Harimesh?
No, I think I have a slightly different idea. I think the insurance space still has to solve the basics as far as utilization of technology is there. Like one final point, I was mentioning this in our conversation also. I think as a space, we see technology as a cost center or something which will lead to some efficiency. It should be seen as the core of how you're building the business. That's one thing which at least I look forward to.
All right. All right. On that note, thanks a lot for all your insights. It was great to have this discussion with you. Thank you so much. Thank you. Thanks.
Thank you for that, Preeti. And it's very rare to have LIC on stage with the ACO and some of the new age insurers. I guess it's a sign of the times we live in. Now, time for a session that all of us have been eagerly looking forward to, because it's not every day that you see two OGs in conversation on stage. Please welcome a banking veteran, the elder statesman of India, Inc., who's had a critical role to play in not only building India's largest bank, but also mentoring the next generation of bankers. He really needs no introduction. Please welcome with a huge round of applause, KV Kamath, the chairman of Geo Financial Services. And joining him on stage is another OG, Kunal Shah, the founder of Cred. Kunal Shah is not only a serial entrepreneur, but is one of the most prolific investors when it comes to Indian startups. We're really looking forward to this. Kunal, take it away.
Thank you so much. Not the easiest session to be conducting, but I will try my best. Sir, thank you so much for doing this.
Why should it not be an easy session?
Well, it's hard to keep up with you. The first time I met him, he knew about all the stuff that is going on, all the cool apps that exist, keeping up with all the latest technology. And it was kind of surprising because I also meet quite a few bankers regularly, and his level of depth for the tenure that he spent is just quite amazing. So, sir, thank you so much for that. I'll start with a question before we move on to the fintech thing. I just want to kind of zoom out and take your view on, we've got this far in India and the economy has done what it's done. How do you see the next 3 to 5 years panning out? What are the challenges you see? What are the opportunities that you see?
Well, I see opportunities. As of now, I think the challenges are visible. The opportunities are much longer than the 3 to 5 year that we looked at. And I actually subscribe to the fact that the opportunities will
take about 25 years for us to really fully max it. And that's based on evidence elsewhere. And primarily, I'm looking at when countries start to change. It's a long run cycle. It doesn't happen very quickly. And we have a case study a live case study of China. We started transforming probably somewhere in the mid 90s. And by 2000, it had started accelerating. And the cycle really went till 2015. And we had to go through several stages, whether it is infrastructure getting built, rural, urban, transportation, every single bit. And manufacturing kicks in. Then services actually takes to a different level, technology. So if you look at each one of these, we are at various levels. But there is so much to do when you see what has been done elsewhere. And along this way, you have a GDP that will accelerate. And that itself creates another cycle. So it's a long run thing, at the end of which I would expect India to virtually be at the top in terms of overall GDP, and then interest rates being stable. That's what we saw in, say, China, Japan, and elsewhere. Inflation being stable and currency being strong. So these are the end state conditions. To reach there, I think it's a 25-year journey. What could have constrained us is lack of opportunity. I don't see any lack of opportunity. So the path is clear. Small hiccups will happen depending on what's happening geopolitically or internally. But these are all small, I'd say, bumps in a long journey.
You were actually a pioneer on investing many of the internet products back in the day, like significantly ahead of its time. And you've seen how the fintech evolution has happened in particularly the last 5 to 10 years. How do you see this in perspective? Like you've seen fintechs emerge, banks kind of trying to get into many aspects of digital. Like, how do you see the interplay?
Yeah, I say probably for today, that's one of the most thought-provoking question that I think anybody in the financial services business has to answer, whether they're a legacy incumbent or they're a new co coming into this business. In the past, when you had a challenge that you thought you could overcome in a particular way, the challenge did not gather momentum that fast. And I'll give a very 30-second example. Late 90s, we were paranoid that the internet is going to wipe us all out as banks. And that took pretty long time. You had to go through several intermediate stages, putting the right technology in, getting ATMs, getting the call center, and then the internet, then the app-based things, and so on and so forth. So it's played out for a long time. But when I look at things now, the pace of change is frightening. So any incumbent in any area of financial services could be threatened by a new co at any point in time, based on several parameters: the ease of operation, the convenience of operation, or the ease of operation, the value for money that the customer sees, and so on. And along the way, we learned one thing very long by, which was very interesting. So we think that trust and brand count. But our experience, late 90s, early 2000, was that actually no. You think they count, and we ran, I would say, focus groups continuously for about 2 years. Initially, it was brand and trust, which we weren't there in terms of that. We were not a known brand. But within, let's say, less than 2 years, as convenience started being visible, you could bank with us on the net, you could deal with us on a call center, and you could withdraw money at an ATM. Convenience became king. So if 25 years back that had happened, you're now dealing with a customer who is much more savvier. So his or her perception of change and what will happen, I think should be frightening to an incumbent who is standing still. Incumbent is trying to move. I would say that move even faster. But otherwise, you could be in threat.
This is interesting, sir. But having said all of this, we see fintechs that are kind of coming from, let's say, in terms of markets or insurance, kind of doing well because they usually get the similar status as the companies that they're competing with. They get the same license. Fintechs, on the other hand, do not compete with banks directly. They are kind of either serving them, supporting them in some ways. They are all on fringes. And today, less than
1% of all the revenue probably is done by fintechs and 99% is done by banks. Do you see this change?
Yeah, again, see, if you look at, you mentioned that market players and other players, how the moves. Yeah, if you look at broking, it's already disrupted. I think the next disruption is AMCs. And thereafter, I don't think it's going to take too long for the regulators to open the window wider for other players. Even today, the revenue model of fintechs, in a way, is constrained due to certain, I would say, limits put in by the regulators for maybe valid reasons. For example, deposit taking is being done well by incumbent banks, and that's something that no regulator wants to cause any, I would say, challenge in the sense, not challenge the institution, but cause any waves there. So that's kept steady. But you imagine when other players come into this market, what will happen? At the other end, you take entry through the capital market process. You come in through the capital market, and that market is growing in size. Pensions and insurance money is coming there. And corporates, large corporates could go in directly and borrow from the marketplace. For infrastructure projects, so far, which is going through the banking sector, could borrow again through an infrastructure development bank type of institution, which has now been set up. So your competitive landscape is changing very fast, not only because of technology, but because of even overall transformation that is taking place in where money is going in terms of your own deployment, the individual's deployment. So that's causing changes which are, I would think, which will become dramatic. Take one small example. Banks survived on CASA. Ka is virtually today is a vanishing word. Only Sa remains. Ka was free in the sense that that's the bank because he didn't pay any challenge. But now, if I have the ability to move Ka into an overnight product, which a mutual fund offers, which is basically it's picking up an appropriate maturity and then bringing down. And against zero, you get even 5%. Why will money stay? So this sort of a transformation is happening at a dramatic pace in terms of what is happening, and that will accelerate. So to bring it to the question you asked, the shake-up has started at the broking level, and it will go up the more difficult terrain, as it were, of financial services. But it's going to hit everybody as we go along.
Sir, you made an interesting point about the rate of change is frightening. And it's funny, when I speak to even founders in the AI space, they themselves feel the rate of change is frightening. And we are all kind of seeing the effects of this around us. But let's say financial services businesses are built like institutions. They're usually built to outlast people who have built it and outlast thing. How do we manage these dichotomies, right? Because like shelf lives, I believe of businesses should be challenged as time progresses, right? But how do you kind of manage both the things together?
Yeah, I think shelf lives will continue to be challenged. For that to be continued to be challenged in the future, you need, I would say, the regulator to have the appropriate outlook, as it were, on how and what it would allow you to do. And take banking as an example. They've done an exemplary job of letting everything in through a sandbox and vetting it, making sure that they are comfortable, and then allowing it to be scaled up. There, the fintech would have probably been able to pose a bigger challenge, but certain revenue streams are constrained. Other than that, in terms of product and all, we are probably offering the best in class globally. Now, other businesses in the financial services sector need to actually introspect and see what is it that I can provide to make my customer more, happier and more satisfied. I heard that earlier panel, it was very interesting, and there is a point made that the customer should understand what is being sold. I can tell you that I, as a customer for a car insurance, don't understand what is being sold. Because when somebody says that this one costs so much, this one costs so much, and they use phrases zero depth and something, I really don't know. So I'm saying, why don't you first put out a sheet saying these are the catchphrases or terminologies we use. This is what it means, and this is what it should do in terms of cost. then putting a comparison sheet for 5 people. No, it's not done. So now who's responsible for this? Each company should say, if you're putting out my product, please put out these things, so the customer has an understanding of what it is. So in some areas we are not even at what I call ground floor level, so you have to go up this thing. Second, you call up for renewal of you get a notice for renewal of car insurance, you call up somebody, then you pay, you get another reminder 7 days later. Now these sort of things, I think tells you where we are, on which floor we are. And imagine you talking of just first level of digital. We're not talking of true AI, and where will we be? So I think, to me, at times it's a frightening scene if incumbents don't change. And you were saying the rate of change of AI. I think as you were coming in, we were discussing this. From what I had heard last, which was now 3-4 years back, the price performance of AI was that was AI of that time, not what we are talking of agentic and other things today. Price performance is doubling every 3.4 months. Is that a 10x increase every year? And compare that to what we used to talk in terms of technology earlier, Moore's law, where a price performance would square, in a way, every 2 years. So we are talking of a different order of things. So we are living through interesting times.
Let's just double click on AI for a bit in terms of you obviously being paying attention to the space and seeing all the evolution around that. What would you advise, let's say, financial services companies when it comes to AI? Like, how should they approach it?
Yeah, I think, if I would go about it, I would do it very methodically. Financial service companies, legacy companies should not straight away say, this is what I'm going to do on AI. You first do a ground up analysis. What is your workflow? What parts of that workflow is today technology enabled? What type of technology are you using? Can that be disrupted? Can you put something better? Then say, now can I put an overlay of something more important, more interesting, like certain AI tools? And then what areas of my operation could benefit from agentic? And I think very soon the answer will be every single thing. So, but if you're not really got a hang of the first layer, then I think saying that I'm going to jump to the third or fourth layer is going to be a challenge. And typically, I think organizations are caught in a trap. And this is something what fascinating in the phraseology that a global bank CEO told me in the 90s. So we were struggling to put our first machine to do things, and we knew that we couldn't afford a mainframe. So we put some Sun microsystem boxes and things like that. It looked very well for us. It could scale up at maybe 1/20th the cost of mainframes. So I asked a global bank CEO, why aren't you guys changing? So he says, my IT department and my executive leadership has a question for him, the CEO. The question is very simple. Whose neck is on the line? If I can give them an answer, then they are willing to do it. But which CEO will tell you that my neck is on the line? So it's the same situation today. So you need a CEO who can shake the organization, thoroughly to get this done. And today, I think technology has evolved where it is not frightening to change. We tried changing conventional software which banks have run on for 25 years. You know what I mean. The same ERP system, the same core systems. We found when we looked out, we said we will build using open source. My colleague came back and said, we don't have to build. We built in BRICS Bank. And we built technology there for less than $1 million. So he said, we can build for that sort of a cost. He came back and said, we don't build. We have a SaaS model ready to go. And it took us all of 30 days to pull out all existing software and put in SaaS, run it on SaaS with not even a day's disruption. All I'm saying is today things are available, and if we have the mindset, we can do things.
Would you be more prescriptive on how should they think about their organizations, or how should they or dealing with vendors particularly?
No, organizations have to be thought on a very simple line. See, top-down technology departments don't work in today's context, and it will definitely not work at the pace of change that we are now looking at. So you will need to have technology embedded in the business. It will also mean that every business head will need to own technology and be able to run it. He may not be a far out domain expert, but he ought to know what is around, what does it do, and then work with his team to provide it. So almost every person in what I would call a transformational organization, or an organization which is running up the path of transformation, would need to have a reorganized business with the technology as the focus in every operation that you do.
Not many years ago in technology terms, maybe 5-7 years ago, there was a huge doubt on this concept of neobanks because they were created, but they were not able to pull deposits of the customers. And I saw a major change, at least it's a Nubank, Revolut, Monzo. Some of these banks actually started doing really well in their respective countries, and they were able to not only just change the deposit ratio, they were the top NPS banks in their countries. They were able to kind of build products rapidly. And I saw that convenience changing to trust quite rapidly. Do you see there is a case for that in India?
That will happen because technology exists for sure. It's I would think the regulators' confidence that we are comfortable letting these neobanks take in their deposit base, which will drive it. But having said that, even there, the regulator has gone up curve. There are payment banks, there are small finance banks, and nothing prevents a small finance bank from virtually becoming a neobank within conditions that have been set for general scheduled banks in India. Because I don't see any constraint that impacts them at all. They could well be a neobank, and there is a plenty. There is low-hanging fruit aplenty, and there is disruption also aplenty. Now, you take a large, even today, you take a large bank, any of the large banks, and you figure out how many days it takes you to open an account and activate it. Open an account, they'll say same day. Activation, 4th day. And you go to a neobank in India, you open an account in 4 minutes, and the next second, you can start transacting. So that's the sort of threat that is there that technology poses. And I would think that all players in the business will have to embrace this as we go along in every area.
Sir, you observe fintechs closely and you've been tracking the space. Actually, before we start, how many of you use Cred over here? Okay, decent market share.
That's good.
Which are your favorite apps in design?
Not in design. I'll say I will talk of use. As of today, the most favorite app is Swiggy, because that's the one I use most. Because I do all my shopping. All my shopping. I have not visited a store in the last COVID period and after that. All my food shopping I do there. So everything is on Swiggy.
Are you already using quick commerce regularly?
As I said, I do at least 5 to 6 transactions a day.
Perfect.
on quick commerce. So I need an app which keeps pace with me, not which tells me now go to your bank app, press on that. Then there's an app, press on that. Then go to this and then press on that. Then press and then put your PIN in. So this is what you are disrupting, right? This is what I'm saying. I'm describing life.
I agree with you.
The number of hands that went up was exactly for this reason.
That is absolutely true. Specifically the younger generation is 100x more impatient. And we are seeing the results of that already. So switching back to fintechs, what are the top 3 or 4 mistakes that you see fintechs make and you would tell them to not?
Yeah, I think the top mistake which I say is some of them have, they're burning money. Burning money is normal in a startup phase. But they're burning money without, understanding when they will need to make sure that that burn stops. There are several metrics to look at it. One is you have money in the bank and or your PE guys or whoever has made sure that you will have a unlimited access with an end game inside. But a lot of them are burning money with no access inside. And I think PE guys then get fidgety, then you will have a problem. The second set is where they could have actually stopped the burn, But, so they've set up a great business, but they don't know what next to do. The top line is growing, but not everything is not going at a level where they're earning a profit. A simple mistake when I talk to them is, so ask a simple question: how much are you losing? X amount. How many engineers do you have today? 1,000. I said that for today where you are, why do you need 1,000? I would have thought your answer would be 25, 30, 40. So mentally I'm figuring out that this guy is losing money because he's got probably 900 plus engineers. He ought not to have, who can be better deployed by other players in the system, and he would be profitable. So I think a little bit of understanding how to do business is also a challenge, and that probably is not being handled by the VC or the PE guy who's behind the funders. There's two. The third is people came in with certain expectations of what the lay of the land would be and what they would be allowed to do, and they have not been allowed to do. This is normal business risk which ought not to happen but happens. So it's somewhere in between this, most, I think, mishaps happen. And there's a last area of mishap, where there is out and out greed. And you start lying even better than, new AI bots can do. Then you have a problem.
Today, less than 2% of India's market cap would be tech companies, and you see now many of them coming. In the US, I would presume that maybe 25-30% is controlled by tech companies. Let's say we are in 2034, sir. What do you see percentage of market cap, whatever the market cap happens to be at that time, will be tech according to you?
I will answer that question by rephrasing my answer rather than market cap. Again, if I look at other domains, primarily China is for us the best comparator set. By last year actually, of their GDP, which was growing at 4.5% maybe, of that GDP, overall GDP, about 35% is accounted by tech, digitech. So we are at what, 5 to 7% today. Now, I would think that as at 5 to 7%, at that 5 to 7%, it's 2% of market cap. If that goes to 35%, over the next 5 to 7 years, I would believe, I think you're looking at 25% of market cap. And see, actually, if you look at the tech companies, other than the big 3 or 4, what I call software companies which have been there for 20, 25 years, 30 years, the new cores are just starting to make money. And some of them listing even as we talk, and the market has rewarded them. There was skepticism whether they would actually have a green bottom line. They have shown that they have, and then market increases further. That is just starting. So you will see the share of overall technology in GDP growing, and along with that, the number of listings growing, and along with that, the market cap. But I think we should be somewhere in terms of overall share of GDP between 25 and 30% in the next 5 to 7 years. And that will translate into a market cap of a like nature.
Do you foresee...
Unless we then have innovator companies. These are basically, by innovator, I mean new discovery companies, like what you have seen in the US. Yeah. We are talking of basically current type of businesses, primarily e-commerce and the various people who are leveraged. Something that is of use to the consumer, but driving it on a technology platform, but not yet discovering new technology.
Got it. When it comes to, I'm going to switch gears to a different topic, sir. You've been an extraordinary leader and have really left a big dent and continue to make large impact as you continue to do many more things. For many people over here are fintech founders over here in the audience. Like, can you talk about, can you demystify what is leadership according to you and how to think about it?
I think to me, leadership has been over my journey, getting a whole lot of things get the equation right, a whole lot of things. But before that, you first need to, in most cases, look at what are the dots out there and make a pattern out of the dots. So for example, if you take ICICI, the journey, When I came back, all I saw was constraints. Development banking was virtually on its last legs. Things had been opened up, companies could not compete. Our access to funding was yanked out because till then we were issuing bonds, which were the government was guaranteeing, banks were subscribing to, and we were lending to the corporate world. That was withdrawn. So you have a situation where your clients are not doing well, your funding source is gone, and there is technological change happening. So you had to chart a path along that. So what did we see? We saw that elsewhere, at around $500 per capita, retail would start growing. So we said, we at that time were around $300 per capita, the 96, 97 talking of, that in the next 5 years, we'll also head towards 500. So we should start building for retail. And then the other change we saw is technology. And at every state there was a constraint. No branches, that was a constraint. So put more of technology, put ATMs in. Of course, now all that is history. But it's continuously looking at what's changing, the dots out there, make sense out of that, and strategically drive that sense to realization. And what has worked for us is, so that is first is get the strategic equation right based on what you see. The second is get your technology equation right. And, we have gotten it right from the time I said no mainframes, we can't afford, to Sun Microsystem boxes. Then the organization went to cloud. And of course, later on, other changes, they would have done at their own pace. So that was the next equation. Then people. And the people, I think, again, we built young people. The second layer below the board, or the layer below the board, was in their 30s, which built all these things that we now see. I'm talking again 96, 97. And they built the ICICI. And without them, we could not have built. And we found something very interesting. If you do it purely on merit, getting people in and letting them grow, and then everything falls into place. Gender falls into place. Organizational, organization becomes very strong, and so on and so forth. So we didn't have to do anything at all. People ask me, how did you get and I call it gender neutral organization. So if you follow merit, then everything falls in place. So to me, these were the three tenets. So get your human equation right, get your technology equation right, and get your strategic equation right, which has to evolve as you go along and can't be cast in stone. And for this, you asked me an organizational question. We quickly learned that in businesses which are changing very fast, and now everything is changing very fast, you cannot have a conventional organization structure because it is too rigid, and then it cracks. When does it crack? You can imagine silos get built, and nobody's coming out of the silos, and the only way they can come out is crack, and then the organization actually starts withering. So you need to look at the organization and the structure as a living organism, which will change shape and character ever so often. So you'll have to make sure that nobody is in a position to build a silo. And the organization is played around with as frequently as maybe 6 months to a year. So that discomfort should be there so that the organization can grow in a healthy way without taking, I would say what I call bad routes, which create problems for you. So that's a tough one. But without that, however agile you think an organization, it atrophies.
So I'm enjoying my free coaching class over here. So I'm going to continue asking questions. You've had such a profound impact. There is so many people who worked with you who've gone on to do great things later on. Like, I mean, there is no shortage of the number of people that kind of happened. So there is something that was right, but I want to move to the opposite side. What are the obvious signs that you thought somebody is mediocre and not going to make it and become big? What are the early reading signs that you have seen?
Yeah, I'll give one key sign. That I call that the ability to accept change and own change. And that I learned it the very hard way. So again, I'm talking of 96, and I'll give this example. You said free classes. This was the class that I attended, 96. That time, Mr. Vagul, my predecessor, and about 25, 30 of the top companies or the CEOs of these companies used to have a session, 2-day session with C.K. Prahlad, Professor C.K. Prahlad. And he would actually teach you. over 2 days. So this was my first experience. So I attended this, and it was frightening because he was telling you what all you are not doing which you ought to do because everything is collapsing around you. That's all fine. Then the afternoon session, he said this afternoon session will be handled by my colleague from Michigan. It's a professor called Professor Wayne Brockbank. So Wayne Brockbank is a professor of behavioral science and organizational behavior. So Wayne comes in and he says, I have only my session is on 3 questions and we'll discuss around that. Question number 1, and all 3 have to be answered by you on a 10-point scale. 10 is highest, 0 is lowest. First, how volatile is your environment? Imagine 96. Everything is crumbling. So no hesitation, 10, meaning highest volatility. Next question was, how capable is your organization? How good are your people? People thought maybe for half a minute, said 8.5, 9. They said volatility 10, organizational competence 8.5, 9. He didn't say anything beyond that, but I think we could understand that, are we falling short? Third question was, what is the ability of your people and your organization to change? Because now you're saying volatility is 10. Now let me hear what you're saying is your ability to change and respond to it. And to their credit, all the CEOs sat quiet thinking. Nobody answered. So I was trying to do a few things very early, my maybe 6th month. Nothing could change. So I blurted out saying 3.5. So my Mr. Vagul, whom I respect enormously, actually held my hand and said, no, man, I think we are maybe 7 or 8. So I even more humbly, and I meant it very humbly, I said, sir, that was the organization you ran. The organization I am running is not responding to change. But what I meant is, you ran the organization in a steady state. I am trying to run the same organization in a volatile state. And people have become conditioned, so they're not willing to change. So this is the major problem that you have to test as to what is the ability of your organization to change. But I'll tell you, the professor didn't stop that. The story ended as a very interesting, I would say, sequel to its ending, a very interesting ending, and an even more interesting sequel to it. So this is 96. So he says, what if I tell you that on that third metric, there's a company on a 10-point scale is 15. So again, now there is very animated discussion. How can that be? It cannot be 30 the senior most leaders in India. And then somebody said, no, I can only think of one situation. There's anarchy in the organization. So the professor said, what do you mean by anarchy? He says, decisions are being taken by somebody down below or this, even before it has been authorized or somebody has acted. Only then can you have change busting the scale. So he said, I think you are right. And he said, I'll give you an example of a company. So there's a company which is, producing something very new, just come into the market last few years. What is happening is they're market leaders now. What's happening is the feedback mechanism starts with the salesman on the floor, on the street, who's going out and selling the store, the product, stock. And then that salesman is getting feedback as to what is competition doing, what to do, and so on. That feedback is going straight to the lab. The lab is working on that. And then the lab, as you have got let's say a prototype which is ready to go, tells a line. Now you may be ready. We'll have to change this because something new is happening. And around that time, it goes up to the ivory tower, to the bosses, to say that this is what the market needs, this is what we are doing, and actually the line is ready to go. So basically the decision making has been shifted from top down to bottom up. So we thought it's a great company. So this company, after many, many years of leadership, some 14 years of leadership, was then in great difficulty or just about to come into difficulty when I had, I associated with that company in some way. It's not an Indian company, it's a global company. And then I met the Indian CEO of that company. He came to see me and talk to me. I said, hey, your product now is getting whipped by somebody else by this simple change that you could do. And you are masters in technology. Why haven't you done it? Why hasn't your lab worked on this? So it was like opening a thing to him. He said, oh, Mr. Kamath, you won't believe what I say. When I tell them this for 2 years, they're working on it. Then I said, but what are you busy on? We are working on a product which will work on the moon. So you have a situation where you lose your way over 15 years from being market leaders, and your concentration is on working on something that will work on the moon. I'll name the company, the sequel. Can you guess the company?
I'm just trying. I was constantly trying to think about that only, and I'm like, who's working on the moon?
Nobody. No, but I'll demystify. This is Nokia. The professor gave the example of Nokia 1996, a market leader, absolutely sterling company. And the product that is a competing product I'm talking of 2008, there is a dual SIM phone, which is what single-handed, wiped out India for them. And that came in at that time from Samsung. And then the others started. So how losing sight of what is your focus area and then doing things can land you into trouble.
Sir, this has been great. I just want to take one final thoughts from you on we're going through change, and literally everybody is at 3 on 10 right now in the way we are managing change right now. And it doesn't matter what org we're running right now. What would you advise to everyone over here on your final thoughts on how to deal with change and how do you deal with difficult, hard decisions?
I think nothing has changed in terms of how to deal with change. I think we need to be well ahead of, in terms of recognition, well ahead of, where and when it could hit us. Having said that, to me, that answer looks a little dumb. If, say, agentic devices or AI or whatever else follows is going to change shape and character 10 times in a year, and the price performance is going to improve that at that rate, you need to figure out how to run as fast. Possibly, you won't be able to run that fast, but you'll have to try to see how you can run much faster than what you are doing today. That should give you some protection, because complete upheaval won't happen, but you will need to be ready for upheavals. And which would mean that you need to have people who are able to change very quickly, i.e. have a larger and larger mix of younger people in the organization. And to me, again, I buy the argument that is put out that what this technology change that we are talking about will bring about is not incremental, it is transformative. So we will need to be prepared for transformational change. Again, all equations that we know may need to be rewritten as a consequence. But that will lead to significantly better product, better customer experience, and that will cause a new business. So if you look at, again, from a Western angle, if you look at the story of Intel, who would have thought 5 years back that Intel would be where it is today? It's as simple as that. You just look at that and you get all the answers that you want. There is no way, say, an NVIDIA, you would have said, would be where it is and Intel would be where it is.
And now we have quantum computing already.
Yeah, and yesterday I was looking at another US company. It goes by the name Broadcom, but it goes by the symbol AVGO, which is a company that they acquired. And yesterday it had a 25% jump in market cap to hit $1 trillion. So this is what new technologies are doing and disrupting incumbents. So I think we need to be prepared for this.
Perfect. Sir, thank you so much for your time. It's been super insightful as always. Everyone, big round of applause for Mr. Kamath. Thank you so much.
I think this deserves a standing ovation because you don't get to hear from Mr. Kamath every day. So let's please give him a standing ovation. And thank you, Kunal, as always, for steering that conversation so well. As you said, that was management lessons on steroids. And so just one last question. What's your learning process? Like, how many hours do you read every day? Because all of us have so much of catching up to.
Yeah, don't make me say it and they'll laugh at me. My learning process ever since COVID primarily is YouTube. So what do? So last 1 hour before I sleep is definitely YouTube to understand what's happening and what others are talking about. And I'll tell you currently what I'm trying to do is I'm following a trucker's blog that's going all over India. And the idea, what am I getting out of it? I'm getting what changes happened in India because no other leisure traveler is getting me that. I'm seeing the truck going by, and this trucker actually stops and sees what is being farmed, things like that. So I'm seeing the transformation happening where it was rice or wheat. Now there are value-added crops. There's dragon fruit. There's pomegranate. All so there is change happening, which sitting here I wouldn't learn. What is the sort of network Mr. Gadkari has created? It's amazing. So what are the things that we can now do to even make the whole program better? Small things like having better rest stops. The toll is working much better than our ceiling toll, much better. So these are lessons that I learn. So at each, it's not that I'll follow it ever. I'll follow it for a month, and I'll move on to something else which is more educative. So all my education is coming from.
Settle with the audience. Kunal, Mr. Kamath. But thank you so much, and a huge round of applause for Mr. Kamath and Kunal. Thank you very much, both of you. Thank you, sir. Thank you. Wow, that was such a riveting session, but the action doesn't end here at the Moneycontrol Fintech Conclave. Please settle down, because we now literally we will traverse the journey from fintech to technology, and for this we have an expert who has been working diligently to simplify how organizations develop, deploy, and run modern applications. To take this conversation forward, I'd like to invite Bhavya Dilip Kumar from Moneycontrol, and please join me in welcoming Krishna Tirtha, Regional Business Head of Couchbase. A huge round of applause for our next guest, please.
Check. Kunal, you said moderating that session would be hard. Imagine moderating the right next session after such amazing panel. But we're going to try and make it more interesting. But thank you so much, Krishna, for joining us. So Couchbase is a very popular firm outside India, but we want to know more about what's happening here, right? Couchbase is a NASDAQ-listed firm. You're sitting on a market cap of 800 million. So tell us your India market. So throw some light on what you're doing in India, your customers.
Sure. Firstly, it's a privilege, sharing the same stage as what we just happened to witness.
Truly.
So I'm still reeling from that session. It was pretty loaded. That said, I'll try to do justice from what I can. So from a India presence, as far as Couchbase is concerned, so more than 35% of Couchbase's global workforce is based in India, primarily working on the engineering and the support functions. And that said, our India field go-to-market efforts started just after our IPO in 21. And that is where, we are a relatively new entrant into India that way in this interesting market and interesting times. And the other thing I would like to call out is in terms of, while it's just been over a year and we are kind of, while yes, someone who's been in the industry working for Couchbase now, but that said, the journey and what we are seeing with our customers, thanks to the way the technology is architected, the way it is built, the sweet spot is, because just some time back, right, Sir spoke about, on one hand, the dichotomy, right, opportunities, challenges. So your legacy tends to hold you back from the opportunities that you want to go after, right? I think the sweet spot with a technology like Couchbase is the ability to blend in terms of, the technology landscape that you already have. And given that we come from an open source world, our approach is also to look at, it's just not paying lip service to a problem solving approach, but we genuinely, that's the way we engage with our customers, right? We take a very problem solving kind of an approach, one step at a time, right? And then go about the journey completely involved. Yep. So, and then I'll share some interesting stories with you a little later. Yeah.
Please go ahead.
So in terms of, I'll just try to build on the previous conversation that we had in terms of when it comes to opportunities, right? And at the same time, challenges holding you back. So now as far as the tech part is concerned, I'll try to stay away from getting deep into tech, but the premise of Couchbase, right, is today, if you look at the world of data and today, You're all reading, and of course, it's a fact that data is the new oil. And the importance that one needs to go about a data management strategy or going about a data platform strategy is extremely important and critical, right? And more so than ever before. Now, again, we have AI coming in, right? So with all this happening around, I would probably take a few use cases today where we have been able to play a role in an ecosystem where there are already people, or I mean to say there are already technologies which are present, but at the same time, in terms of how we can blend in. So one example that I can talk about is that of LinkedIn, right? Most of us here, I'm sure, use LinkedIn.
Yeah.
So what Couchbase, while I will get into some fintech examples too, but that said, LinkedIn is a cross-industry example and something that people can easily relate. So now, as far as LinkedIn is concerned, I think they have close to about 800 million plus users. So while they have, a data management system, Couchbase is actually looking at primarily powering the what is called as a caching layer. So caching is again something that came into prevalence in the last 1 decade or so to primarily boost application performance. Basically, when it comes to real time, where it has to be like in milliseconds, right? So the personalization, the profiling bit today, when it comes to when you update your feeds on LinkedIn, right, that particular entire session management profiling data is managed by Couchbase. And then few examples from the world of I would say financial services. FICO, which is also Fair Isaac. So they have a platform called as Falcon, so which is basically a fraud detection, risk and fraud detection kind of a platform, right? So the key thing here is for this platform to run or to be powered, it needs to kind of deal in a millisecond response time. So especially when you're swiping a credit card, right, it should be able to detect if there's any potential fraud. And FICO, with this particular platform, we're given to understand like they have a market share of more than 60%. So I'm happy to share that a platform like Falcon is again powered by Couchbase as far as their fraud and risk analytics go, right? And from an Indian context, right, we are fairly new, but we have kind of seen few customers who have kind of given us that opportunity and embraced the idea of how Couchbase can play a role. While I can't take the name of this particular customer, but they're one of the leading NBFCs, part of a large conglomerate house. So this initiative was around customer 360. Today we all talk about when it comes to embracing new opportunities, customer experience plays a very important role. And as far as your data goes today, and I'm sure you will be dealing with this thing that data is all over the place. There's a sprawl of data stored in different systems. So there is an initiative few companies are running today about building the golden record for a customer or a consumer, right? So that mostly gets people relate that to as a customer 360 initiative. So and this was particularly an effort where they had to augment 7 different business units, bring data from different systems so that they're able to offer one interface to a customer, right? So it can be looked upon as a super app. So that's again, we had the opportunity to work with them and serve them, right? So that's again a scenario where you can look at Couchbase. Yeah.
Wonderful. I think going into fintechs, right? 2025 is going to be the year for many of them to scale, but that too in a cost-efficient manner, right?
Yeah.
How can platforms like Couchbase come in here? What kind of synergies will they create? Can they address these two important factors?
Sure, absolutely. So what I'm going to share now may sound very basic, but you can't shy away from basics. So one of the key advantages of the way Couchbase is built, than just as a database product, is actually as a platform. So and you can and one of the main highlights is the modularity. So you can use Couchbase while it's a distributed high performance platform, but for very specific use cases, right? So thereby you don't have to, if you're looking at some initiatives, right? Let's say caching as one of the examples, you don't have to rip and replace your existing database systems which are there. We can potentially play a role, and some of the use cases that we have is just that, where instead of ripping and replacing, which will again hold you back, many a times people, then again tend to kind of, that becomes a big bottleneck, right? So we can actually kind of do an incremental thing in terms of, in this case, it could be about building a caching layer. The other thing is, in terms of the design principles that we have gone about, so we use something called as SQL++, which is one of the most, so SQL as a query language in the world of databases. More than 60% of the customers today are familiar with SQL as a query language. So we use SQL as a programming language. So there's not much of a reskilling that one needs to do when they look at Couchbase. So this is just again one example where from a total cost of ownership standpoint, you don't have to again go for reskilling and skilling, right? Is again a very, very important aspect today. That is holding up a lot of companies today when on one hand you have to build new applications, and Sir was talking about SaaS, right? Eventually it's about builders. So at the end of the day, we believe in doing things, which is very pro builder, or I mean to say developers. So this is one of those, yeah.
Wonderful. I think we have last 1 minute or so. Can't be without asking you this. What about AI? Because now every fintech wants to innovate in AI, but what innovation did you come across recently within fintechs that's really exciting for you? And how's Couchbase powering that?
Yeah, sure. So I'll just take a step back. See, when it comes to AI, the thing today is people are looking at, again, first of all, there's a data sprawl, right? Different applications are powered by different database systems today. So, and when it comes to AI, and one of the key things about AI is what we call as unstructured data in the world of technology, right? Which is, akin to text data. So you need databases today, you need systems today which can actually deal with large quantums of data on one hand, right? So it's just not about the ability to what you do with the data, but something that can hold and process it at like amazing speeds, right? We are talking about sub-millisecond kind of performance. So there's scale, there's speed. So as far as Couchbase is concerned, as a platform, we are built for that. And then the other thing is, if you are on the Couchbase as a platform, so you don't have to again make new investments. For example, when we are talking about buzzwords like today, RAG or vectorization. So people, on one hand, the market has new entrants, right? Again, purpose-built databases. So we are saying if, you're on Couchbase, so the data format for Couchbase is something called JSON, which is one of the most preferred data formats today for the world of AI, right? So we are a JSON-built data store. So it becomes very easy for people to basically build on that without having to invest in new technologies. And then from a developer standpoint, we have again brought in the agentic AI aspect. So when it comes to building applications, so from a database perspective, at least we are making sure from a time to market perspective, they don't have to go about relearning, and this particular agentic AI aspect, what we call as Capella AI services, aids in making a programming or development much faster. Yeah.
Wonderful. I think we've come to the end of this session, but beautifully summed up how not just having rich data, but also a solid database management system and data management resources needs to be there in place in order to win the game, right? Thank you so much, Krishna, for the insights.
Thank you. Thank you.
Thank you very much, Krishna and Bhavya, for that very engaging conversation. Bhavya, I'm going to request you to stay back on stage because we will take the conversation on fintech and infra forward. Bhavya, if you can stay back on stage, please. Right. Now, from food delivery to cab hailing apps, fintech enhances our everyday convenience, and the technology infrastructure has emerged as the potent bedrock, making it all seamless and flawless. Please welcome on stage speakers for our next panel, Madhusudanan R, founder and CEO, M2P Fintech, Aishwarya Jaishankar, co-founder and COO, Hyperface, Nritya Madapa, partner 314 Capital, and Sheetal Lalwani, co-founder JustPay. A huge round of applause for all of these speakers.
Thank you so much for being very patient, and thank you so much for joining us. I think, Madhu, on public demand, we have to ask, you're not in your flagship dhoti style attire. Do you want to add a comment so that...
Well, I just didn't want the attention, so...
Right.
It's the attention by not wearing the dhoti.
Right, wonderful strategy. But let's jump right in. Madhu, I want to start off with you, right? Some time ago on your social media, you had written that what M2P does, or how do you connect M2P as the plumber of fintech, right? That was a very interesting metaphor. But today, when you see, do you still call yourself a plumber of fintech, or has the metaphor changed?
I think I'm just going to quote what Mr. KVK did as a masterclass, which in essence was how we should think of infrastructure and how banks should continuously sort of evolve, and financial service institutions should continuously evolve. And there's great validation of the fact that all of our businesses, is a continuum in terms of how we need to reinvent to help our bank customers kind of reinvent, right? To that extent, we believe that the role of plumbing will be the will be the permanent feature. And in a lot of many ways, what we are attempting to do is actually going in and tapping new avenues and new areas. So what has changed, just to sort of build on what Mr. Kamath just spoke about, right? Last 30 years, the way banks have taken on technology, it started with basic, what you call as systems of record, right? Ledgering. So whatever was written in ledger moved to a, computer, right? Pretty much. And then you had a whole wave of companies that came and offered what's called as systems of experiences, your internet banking, your mobile banking, all of the API stuff that we see in here. So the last 15 years or so, that's what we all have been doing, right? How do you simplify and make that experience better? And what we are seeing in the last 5-7 years is, which is what Mr. Kunal is doing and so on and so forth, is really about building systems of intelligence, right? Which is, how do you augment what's already out there? And a lot of the fintech effort in India have been around how do you augment what the banks are offering, which is what the regulator would also like to see in the market, right? Which is, how do you leverage technology to actually get the banks more intelligent so that they get more efficient, whether it's the form of underwriting, collections, or the way their products are manufactured, or from a customer experience standpoint, how do you actually deliver a world-class experience, right? So therefore, our role as a tech provider will be to really go into that intelligence layer more and more. And if you actually apply the AI superset on that, it will become more and more relevant in the way things are evolving.
Okay, much evolved plumber here. Yeah. Right. So I'm going to throw this question to all four of you here. Maybe Aishwarya, Sheetal, and Madhu, if you can talk about what's one exciting product or a project that you guys are working on right now within your organizations. And Ritya, if you can add which exciting startup you recently met. You don't have to mention the name, I understand, but which business model you were really impressed with when it comes to fintech, B2B fintech, right? Aishwarya, you want to go first?
I think, hi, thanks a lot for having me, Bhavya. I think when it comes to banks and fintechs, the biggest problem is differentiation. It is very easy to offer the same old, and a lot of times what we've been doing over the last 10-15 years, being part of it as a banker to now, is we are augmenting what we have stronger and better and offering technology or digitizing everything. But how do we disrupt everything? At Hyperface, we believe that you need to create a lot of first principles, bottoms up thinking to reimagine banking products as well. We are very excited about our credit line stack, which can be used on top of a card, which can be used on top of a UPI line, which can be offered as a standalone credit line product. Why not a 7-day OD product that will have a different this thing? Why not a working capital financing line? So we are very excited about credit line on UPI as an opportunity, because at the end of the day, India barely has 5% credit cards penetration. And with UPI transactions booming, the ability to underwrite on that data increases. So credit line on UPI could be something big is what we are betting on.
Right. Sheetal, you want to add?
Sure. JustPay has been building a payments platform for the past 12 years. I'd say includes orchestration, checkout. Past couple of years, we've actually been working on open sourcing it. So we've completely rewritten the entire payments platform which we built, and it's catering to the Western markets. Firstly, now it's called Hyperswitch, and our vision is to make it like the Linux for payments. We want it to be a core utility, like in tech we use Redis, we use MySQL kind of system software, Linux kind of stuff, right? That's what's exciting for us right now.
Linux for payments.
Linux
Nicely
for
put.
payments.
Madhu, one exciting product.
Yeah, I think so. Couple of things, right? One is, I'll probably limit it to one. A lot of the work that we are doing in India is actually, we are able to take out to other markets. So if we look at payments, I think we have kind of progressed way ahead in terms of the capabilities and the scale that we are able to do. So in fact, to the extent where in a lot of other markets, we are actually able to go out and say, this will probably work well because we have seen it at, operating at a country scale like India. So we have been able to actually bundle the whole payment, capabilities into one unified stack, which we've taken out to other markets, and there's a fairly good reception for that.
Wonderful. Nritya, you can name the startup. I mean, we don't mind.
No, one of the really beautiful things about Fintech Infra is that they're not really the sexiest businesses, but the deepest businesses. They go after like really, really hard problem statements. The things that we love in FinInfra founders are the ones who see the longer game. This is not a short game, build a product, get it out there. The buyer never buys in the span of a year when we see typically
That's
like,
true.
so these are folks who embed, build the product right foundationally, think very platform first from the get-go, and sort of run counter to the narrative that's happening in the market. And very recently, we've made an investment in a B2B cross-border payments enablement play that's really building it from the infrastructure up, starting on the B2B, integrating with the regulators first, having that conversation from day one before they had a product. Like it's those very intentional builders that we like to back. Most recently, we've seen the one that I'm really excited about is just going after collections very, very intelligently in this country. So that's why I sort of prepped my statement with these are very unsexy fields, but very, very deep, never been really, had that layer of intelligence put on it in the way that actually the technology of today demands. And that's the kind of stuff that we're really excited about. Very founder first when we think about who are the right sort of archetype fits for FinInfra, which requires patience and persistence and like really, really long-term thinking. And then, of course, folks going after deep, deep, unsexy markets.
Wonderful. I mean, founders who are just looking to start up, I'm sure they're taking notes. But Sheetal, talking of exciting products, I want to come to you, right? So I'm sure all of you are aware, JustPay was the backbone of building Beam app of NPCI. But tell us, so you literally have seen them from the infancy testing phase to now what it is, right? So from the infra perspective itself, do you think Beam has what it takes to compete and take over Google Pay and Phone Pay?
Can I plead the fifth? See, of course, let me tell you what, experience wins. That's if I have to put it in a nutshell, right? Of course, there's a possibility, there's always a real feel that if you build the right experience, of course, there's other things which need to happen for it to do. This is the question you're talking about.
Yes, it's the surprising.
Yes, I see. We built Beam and we handed it over to NPCI about 1.5 years into the journey. So we've not been involved with it in the last 4-5 years. We've been building more infrastructure backend. Can it happen? Absolutely. I would like to believe that anything's possible, but there's a lot of stars which will need to align for those kind of things to happen.
Got it. You've aligned the infra star, but the rest all needs to get aligned. Understood. Thank you for that. Madhu, coming to you, I think both M2P and JustPay, you guys have been on an aggressive global expansion spree as well, right? So what's exciting about global markets? And if you can also add on, what are the new markets that you're entering? But how do we also read this? Do we see India market is saturating, or do we see this as a revenue expansion strategy for you guys?
I think, two parts, right? So one is that obviously there's the heterogeneity as well as the vibrancy of India market in terms of the breadth of action that's happening and the scale at which it's happening. Very hard for some other market to actually sort of take in and do this, do at the scale that we are doing. Traditionally, if you see, most products have come from the West. We have just been, a net importer of technology, banking technology in general. Over the last decade or so, I think we have probably turned net exporter of technology, if you know what I mean. So therefore, a lot of pride in the way that we have built some of the products and capabilities in here. A lot of the markets actually now look up to India in terms of what has happened, because there is a macro that's playing out where people are, sitting and taking notice of the fact that UPI is scaled, and we've got a framework around data sharing that's legit it can stand the test of law when somebody arbitrates and things like that. So therefore, a lot of folks around the world actually look up to India now, and it is a big secular shift. Normally, we are known for being the global back office and build technology where there's a cost arbitrage. I think in banking and financial services will first be the first one where some of the product capabilities will actually go out and put India on the map. Yeah, very excited. I think all of us are very excited to play our part in that. Yeah.
Aishwarya, has Hyperface gone global yet? Or-
Yeah, we have started. Obviously, we'll follow the footsteps of M2P, Perfios. In fact, I was just sharing with Madhu the other day. When you talk to new markets now, they say, "Oh, are you like M2P?" It feels good that the framework is Indian technology. Then also it becomes easier to say, "Oh, they do this and we do this." But honestly, I think I agree with Madhu there on the opportunities, and also with all the hard work, the best core banking in the world today is an Indian company. It is Pinnacle Infosys according to Gartner. So I think definitely it is the time for India and Indian products to go out and conquer globally. So yeah, of course, so it's definitely on our roadmap as well.
And there's a lot more money as well. So
Of course. Yeah. Sheetal, which markets are exciting apart from India?
For us, what we've seen is there's a natural affinity, like Madhu pointed out, towards looking up to India. We've seen it in Southeast Asia, Middle East, and also LATAM. It's very interesting. See, globally, at least the problems which we look at, it's very similar. Merchants globally need a payments infrastructure for dealing with complexity, growing regulation, diversity, and all of that, right? So that's the reason why we are going global. Is there's an opportunity for us to do, and of course, we have a team which is handling India. But these markets are natural in terms of India brand being recognized. You go to the US, you got to build a brand, you got to build a different narrative. There's very different. These markets, it's very easy. Like Brazil, they've seen PIX, so they naturally look up to UPI. Southeast Asia, Middle East, it's actually a lot of talent diffusion which has happened. Most of the payments folks are from India, right? So it's happening a little more organically for us.
Wonderful. Aishwarya, to you, right? Hyperface focuses on credit card issuance and everything A to Z in terms of onboarding and everything, right? But with new models coming up, let's take UPI on credit. Do you see that business getting impacted? And we also see a lot of reports about how millennials, Gen Zs take credit, but there's also a high rate of defaults, right? So does that affect Hyperface in any way?
I think sometimes a lot of these numbers are anecdotal. I mean, being an infra tech company, I will leave the P&L management to the expert bankers. You mentioned Gen Z and millennials, the kind of products they need. Today, are the banks really giving it? The recent example being Pixel, for example, HDFC Bank Pixel, which has given the power in the hands of customers. We helped AU Bank launch India's first customizable credit card. So at Hyperface, we think of how can banks launch innovation at scale through our products. And secondly, I think from a credit expansion point of view, I think we are still very low on credit inclusion as a market. Credit card is still a very, very elitist product, at a 850 plus CIBIL or 800 plus is when you can start thinking of a credit card, and multi-carding is the real problem, which is why I feel sachetized credit has to take off in a country. Globally, any developed market actually has a much higher credit penetration, which India doesn't today. I think we are far more afraid to lend. That should
market.
break somewhere, right? And that's what we are betting on.
Got it.
I'll probably add to why we will continue to be relevant, right? So if you look at any large US company, India is never more than a 1 or 2% of their revenue pool. Okay, but we are 20 to 30% of product noise. So their abilities to scale and test and put new products out in the market we will just outpace them forever. There is no way on hell that any American company can come and compete with an Aishwarya or a Madhu or a Sheetal. I'm saying this with a lot of pride because we have seen that transition happen in the last 5-7 years where we will be able to deliver capabilities by the time somebody closes a PRD document. Okay.
Wow.
So therefore I think the bankers who understand this, and I've seen the transition in the last 10 years where there was select experimentation that used to happen where some fintech idea would get tested on our platform to actually now saying, how do we rip and replace, right? So I think that it's just the maturity of some of us as organizations that have evolved, and as well as the market providing that opportunity to sort of do it. Yeah.
Great. I think we are running short of time, but Nritya, I want you to come in here, right? From the consumer fintech perspective, we do see a lot of players, but when it comes to fintech infra, players are less, and scaling them is very hard. Is the market very hard to crack?
This is similar to, I mean, you're selling to an enterprise customer. You have to, again, have a very, very high bar of product. The same thing that I mentioned, you think platform from get-go. It's a difficult customer. It's a regulated customer. You're thinking about these things very differently. I don't think the market is small, and the market is global, as we've just spoken. It isn't even just restricted to India. And I think that's very deeply expanding. Consumer needs are far outpacing anything that the financial ecosystem is serving up to them, whether it's on just even access to credit or the sophistication of the products, or even the ability to personalize things, as Aishwarya mentioned, or even to catch up with things like, for instance, fraud, and how that's evolved over the last few years, with the explosion of genuinely not needing any tech skill in order to orchestrate very sophisticated institutional frauds, both on the financial institutions and on the consumer. So FinInfra's market continues to expand. The use cases continue to expand. There's a long way to go before we're able to keep up with both what the consumer needs of financial institutions, or the different ways that they will stress test them going into the future. So very bullish on that. Why are there fewer? Banks do like to buy multiple products, deeply integrated products. It's a matter of trust. It's a matter of enterprise sales. So it isn't, you can't have a plethora of companies servicing the same types of customers. They do buy a certain way, and they'd like to sort of like deepen their relationships that way. So it is a fewer companies, much larger base of business to go after. So if you're thinking market size, I think you should think both ways.
Wonderful. On that note, I think we have to wrap up this panel. We'll talk a lot of the stage, but thank you so much for joining. Thank you so much.
Thank you.
Thank you.
Thank you for that, Bhavya. I was hoping Sheetal would make a prediction on Beam, but clearly he's dodged that bullet. But we'll see how the battle for Beam plays out. But a huge round of applause for our panel here. At this point, I would also like to acknowledge the presence of the CEO and MD of India's OG FinTech, the National Stock Exchange, Mr. Ashish Chauhan, is with us in the hall. So thank you very much for coming and attending our FinTech Conclave. We just have one more session and then you can listen to him. From FinTech Infra, we now bring the banks on stage. It's time to really discuss how far banks and fintechs have come together to collaborate on products, processes, and technologies. Has the journey been smooth or not? How can we have a happy marriage between the two? To moderate this session, let me welcome on stage Hamsini Karthik from Moneycontrol to take the conversation ahead with some of the top banking executives. Parag Rao, Country Head, Payments, Business, Consumer Finance, Digital Banking and Marketing, HDFC Bank. Divya Sehgal, Partner, True North. Ajay Rajan, Country Head, Government, Multinational and International Business, Transaction Banking and Knowledge Units, Yes Bank. Vishwas Patel, Joint Managing Director, Infibeam Avenues. A huge round of applause, ladies and gentlemen. Hansini, the stage is all yours.
Thank you so much, Chandra, for the lovely introduction. And I think a stage in a sense was set by the session ahead of us, Mr. KVK and Kunal's. He spoke about how when internet proliferation happened, banks were even a little threatened that they'd be taken over by the internet wave. Something similar happened when fintech started coming into the picture. Back in 2018, 2019, there wasn't so much acceptance to fintechs by banks. Banks thought their dominance was going to fade away a bit. I'll start with you, Vishwas, because you possibly hustle and battle with banks on a more everyday basis among a lot of us here. What what are the few things that have gone into this journey as at a company level for you, in order to ensure that fintechs find better acceptance from banks in terms of building a relationship, working together with them on products?
Thanks. If you see from 2000 when we launched till 2014-15, it was a simple acquiring bank relationship with the banks and smooth going on. What was going on? I think something changed in 2014 when Prime Minister Modi ji came into power. The whole vision of Digital India came into being, and with Digital India, all the associated things, right? Be it from NPCI coming in the fore to the Jan Dhan Yojana, where 400 million accounts were given, 900 million plus debit cards were issued in the market. So a lot of this access happened. So the first round plus the two events of demon and pandemic, really accelerated. So the initial thing was the ability to pay. So that's what they were solving, where with all these bank accounts, people will have access to pay and other things. Till then, everything was going. But then when the shift started changing to ability to collect, right? Where, if there are 900 million debit cards and other things, that is all sorted. With 300 million now UPI users sorted. But the acceptance part is where the challenges is. That's where the real partnership with the bank started, right? And that's where the whole push came in, that how can we have a billion Indians who can collect also, 550 million plus SMEs, MSMEs can collect too. So that's where the partnership with the banks happen, where vertical wise, it's just not a vanilla payment gateway. It is that if it's a hotelier, how do you build a central reservation system with a booking engine and payment gateway? If it's an insurance industries, if it's an education, how do we build that form collection? So that's where the partnership with the bank started. So that's where the acceptance came in, and ultimately it's driven from the top, where Digital India Mohim is going on, Har Payment Digital is going on. So definitely, and we all, DPSS Act came in place, and banks and we both are regulated together. So the acceptance automatically started with the fintech banks.
Great. We'll move on to the banks itself. How has working with fintechs helped you both, Ajay and Parag? Has it made your life easy in terms of faster execution, and has collaboration yielded in better results versus you doing it all by yourself? We'll start with Parag.
Let me just thank you very much. Welcome to be here. Let me just step backwards a little. So, working with fintechs, banks working with other partners, I think has been nothing new for the banking industry. Let me just refresh. Vishwas just happened to allude to it. Even 25 years back, we ourselves were a startup. 25 years back, okay, if you may call so. We worked with many startups, BuildDesk, I see Vasu in the room, Pine Labs, FSS. These were all startup, and we co-created, we built up journeys. The acquiring business is a huge, actually, study case for partnerships, and so the ethos of working with partners and partnerships, I think, has been there in the banking industry for long. This version of the fintech post 2010, 2011, you may call it whatever, fintech 2.0, 3.0, I think only brought in a slightly different type of, where different categories sort of expanded, okay, and it also brought in, I think, many more new ideas and innovations, etc., in the space. Okay, so I think the first couple of years went in, I think, trying to understand what's happening, what's this innovation, why can't we do it, so on and so forth. But I think after that, and I pride myself in the bank to have started a lot of that, to say that we've then started realizing that if we can be clear about who brings what to the table, okay, if there's role clarity, if there's an understanding of how do you treat the customer, how do you look at the infrastructure which you build, what are the benefits which each partners bring to the bank, I think it makes for a good, lovely recipe for working together. We've got enough a number of working models today, and in definitely many areas, we see a lot of value being brought to by the fintechs, especially when we partner together. Fundamentally, three models we work on. One is where we just work with the fintech partner and use his platform, let's say, as a distribution platform. That's one model. It's quite prevalent in the industry. The second partnership model is a co-creation model, where you could create a product or a program or a platform together and go to specific markets with set objectives. The roles of both the bank and the crystal clear. And then the third area, which is not the glamorous area, but I know there's a lot of work happening across many banks, is the backend, as you call, operational efficiency, AI, building in tools, building in complete backend processing platforms, etc. There's a lot of partnership, I think, working. So we at the bank, I think, and I personally, I think, see a significant amount of benefit by bringing in two minds together, two styles of working together. And of course, we're a deeply regulated industry, so you have a lot of guardrails around. You can have a debate on whether they're good or bad, but I think I think it makes for thing. And in my view, I think partnerships are only here to stay, and I think they need to be encouraged.
This is a view, Ajay, you've also been having for a very long time, that fintechs have to work, or rather banks have to work with fintechs and not consider them as competition any longer. You hold on to the view?
Yeah, absolutely. And I think this has been a well stated view, from both as an organization as well as mine personally. So, and again, we are a startup greenfield bank, so we do understand that thought process and mindset of building from scratch, and both innovation and infrastructure, technology infrastructure, as a bottom to kind of create that. I think in addition to whatever Vishwas said, one more thing happened fundamentally which actually transformed the way the industry grew, and that was the APIfication of banking services, right? So the whole API banking concept, which till then was more a retail kind of concept. When you corporatize that whole API banking is, and it kind of coincided with the whole DPI in India. So Aadhaar came in place, Jam Trinity came in place, UPI came in place, and that's when when banks started exposing APIs to other partners, and that's when the co-creation started in terms of business models. Phone Pay started, and so on and so forth, right? So that's really, I think, which was the defining moment. If I have to summarize in terms of how do banks and fintechs work together, co-create, and also derive value from each other, I would put it into three buckets. First is partners, fintech as clients, right? So bank and fintechs engaging with each other as a banker and customer, and this is where the whole API banking model comes. Where you co-create solutions, you co-create business models, and then the bank provides the rails, the fintech provides the innovation, the front end, and you kind of drive business and make revenue, right? The second is where fintech as partners, and this is again where because the DPI in India is really constantly changing. Regulator is really on an overdrive in terms of making sure that banks are also up to the curve. And the third and the most important thing in my view is the changing customer behavior. Mr. Kamath himself said the app that he uses the most is a Swiggy app, right? Now, what happens is when a CFO or a treasurer is using those kind of apps for their personal lives, they expect that the same thing should happen at the bank end, right? So the banks necessarily have to upgrade. Now, not everything can be created at the bank's end itself, so they necessarily look at partnership with like-minded fintechs or tech fins, and they co-create those solutions, right? Of course, like Parag rightly said, guardrails in terms of data protection and other DPDP and all that needs to be cybersecurity needs to be taken into consideration. But that's the second part. The third most important part again now, which is a ongoing trend now, is the partnership between banks and fintechs as connected banking partnerships, right? So what it means is, you are actually working on an inorganic customer acquisition model. So, whether it is across assets or liabilities, the whole DLG guideline, for example, when it came, how do banks and fintechs, for example, work together and originate loans or originate current accounts, right? So that's actually a more evolving model, and I think that is really what will set the stage for the next few years, where banks will run their own organic model, and they will work along with fintechs, to co-create a inorganic model. So it again becomes a win-win solution for both, very sticky, very remunerative, and customer wins.
Great. Divya, I'll come to you next. Is all the optimism that's going around here compelling enough for you to put your money in a fintech when the so-called funding winter 2.0 comes to an end? Because you took a very bold call by investing in SFBs like most of your peer private equity firms were doing back in 2010 to 14. Would you be interested in a fintech now?
At one level, as the private equity industry, right, what we are paid to do is to track trends and then to sort of spot organizations who are doing and benefiting from that trend and making that trend happen or disrupt, whichever way you look at it. So if I firstly step back and look at fintech, right? The spaces where fintechs obviously had meaningful and very significant impact. Payments, I guess, is the foremost. We all can agree. Obviously, insurance marketplace, policy bazaar, right? A lot of FS infrastructure, and we had people in the prior panel talk about it. But equally, there are enough spaces where it is, I think, still work in process, right? It is work in process. Business models are still getting built out. Revenue is also still getting built out. I think clearly there is meaningful amount of partnership between fintechs and banks, as it should be. It's a regulated space. Banks are regulated entities, and a lot of fintechs are enabling banks to leapfrog, right? Now, with that said, the holy grail, which is B2C, is about customer ownership. And all banks are very clear that the customer ownership sits with them, which in itself has a certain limitation that puts on fintech their business model and their attractiveness to a fund, right? So I think that part of how this thing would be cut and how it would happen. For example, Policy Bazaar, right? Policy Bazaar, eventually a lot of the customer ownership sits with them, right? They are able to move a customer from, not that they want to, but eventually that's where it rests. And that's where the value of the organization comes from. For that matter, PhonePe, for that matter, others. Right? So I think that part, still the water needs to settle. And obviously, it's work in process. So we'll see how that goes.
Great. This is also a panel, one of the rare fintech panels where we have 3 listed companies. So there's no getting away from compliance. That was one of the pain points when it came to banks partnering, or rather fintechs partnering with banks. Initially, a lot of the deals would go through advanced stages of conversations, but we would drop out because compliance was an issue. Parag, how do you see that evolve now? Do you see that fintechs understand compliance better today?
Well, your simple answer is, I think, yes. I think there's a clear consciousness of the need to adhere to the guidelines and protocols laid down. It's a necessity. There's a rationale behind why most of the regulations are in place. And that's a larger rationale. Initially, I think there was a lot of teething issues, problems, why, what, how, fundamental questions around it. But I think that's being bedded down right now. You can debate whether it's forced, you have no option, or it makes sense. But I think that consciousness is clearly there. We see most fintechs first talk impact compliance and then get down to the product, etc. So I think that's a good thing.
You agree with Parag,
Yeah, so the only point I'll make here is, you always have two sides of the coin, right? So there have been few players who have always, run their business model on very solid, business model, very strict governance, compliance. Vasu's here, I think, his company is a case in example. But there have been a lot of models which have been built on regulatory arbitrage. So, gray lines in the regulations have been identified, and models have been created on that. Now, it is not that the regulator is not aware of some of these things, but when that model becomes a systemic risk, right, when customers could get impacted, is when obviously they take serious action, and which has we've seen that happening, right? So it is not that there was ever any ambiguity in terms of what the regulator expected in terms of some of those guidelines or in terms of those requirements, but I think a shortcut was always taken by a few of these players. Those have been corrected by and large, I would believe, now. And I think there is no ambiguity now in terms of what the regulator expects. So if any doubt, there is a sandbox. Come to the sandbox and discuss. There is a fintech department. There is a interaction which happens. Come, ask, and resolve your issues, right? So there is a very open, transparent model with the regulator now. And areas like the P2P guidelines or the DLG guidelines, the ambiguity which was there has been set to rest. So I think by and large, and the PA guidelines have also come, right? So by and large, all models now stand corrected, and hopefully people should abide by what is not only written but also by spirit, and run their business models. And then they can put money into them.
Great. Vishwas, one or two things quickly, if you can tell us, in the process of becoming more compliant, that as an industry you did in order to ensure that you stay within the rule book and win better confidence from banks.
For us, regulation is a culture. Like it's a reflection of a culture. So the guys who were doing it traditionally were working when there was no second factor authentication, when there was no PCI compliance and so many other things. So with a 16-digit number card. So that's where we built in models, where we built it slowly and steadily, how to secure the transactions, how to look at merchants, how to look at this. Smoothly going on from till 2015, 2016. But that's where fintech as a investment destination for VCs and private equity came in, and so much capital was done. So what happens when this capital comes in? The fintech founders are on a fast treadmill, so they have to perform quarter on quarter, and that's where merchants who should not have access to the Indian banking system got this thing, and that's why the regulation become more tougher. So like even a Chinese sitting out there is getting access to Indian banking systems, or pornography sites or gambling sites from international, and money being betting winnings being paid out. So that's what started happening. That's why the regulation became more and more tougher and more and tougher. So that happens is when you take outside funding. Fortunately for me or many, we didn't take funding, so we were going spacious. So those were not affected. The regulation is part of our culture. It reflects what we always kept on safe ecosystem. So that's how we have grown.
Just one last round as we wrap this. Vishwas, we'll start with you. If you would want to revisit and change one thing that you've done in the past, which you think as an industry you could do better, what would that be?
Not we could have done, but I hope that incidents that happened, what happened in 2014, when Prime Minister Modi ji came in and others, if that would have happened in 2004, when the whole world was bursting with digital payments, like we had the Squares and the Braintrees and the Stripes happening in US, and we had the WeChats and the Alipays happening. And that's a decade that we lost in 2004. And at that time, if Mukesh Ambani had chosen telco as one of his parting ways with his younger brother, and Jio would have happened 10 years earlier. So today, instead of 250 million Indian transacting on the digital, we would be somewhere around 700, 750 million today. That lost decade is something that we want to change.
Great. Parag, there are a lot of fintech founders here. One advice that you would give so that they get better acceptance from you?
I don't know if I'm qualified to give that advice, but I think the banking industry, especially for large full suite banks, the opportunities are significantly large. Okay, and in each area, I think the bank is looking out for areas to innovate, areas to scale, areas to keep on providing far more value to the customer. So there's ample enough opportunity with unique ideas which can partner with the banks to help scale and reach out to that huge customer base. So I'd only say reach out to me, reach out to the bank. There's many more areas, and we're on the lookout constantly for good partners who'd help us sort of bring in more new products to our consumers.
Ajay, when you were the bank in the payment space, the leader in the payment space, you were largely holding the market share. Today, there's quite a bit of competition there. What are you doing to ring fence yourself? And is it possible to even ring fence in the space that you are in?
So correction, we are still the market leader in the payment space. So we practically manage 1/3 of India's digital payments. Even now. And so I think that's a space where, we kind of pioneered in 2015. Till date, we have continued to be market leader in that space. And I do foresee that at least in the near foreseeable future, we will continue to do that. But having said which, and it's not only about UPI, we kind of have good leadership in practically all the payment modes in the country today. And the reason why I'm bullish about continuing to have a good share there is that all of these volumes are it's not only our own volume, right? So it is a co-created model. It is a partnership model with all the players. So we will obviously continue to do that. You're right that there are other players, but we do believe that the tech infra which is created, and Sheetal is here, one of our partners, Madhu is there. So we will continue to work with those partners. And more importantly, all of this leadership is because of solutioning that we have created with our partners, right? So that continues to be a differentiator for us, and we will work on that and create those solutions which will differentiate us versus, from a customer lens perspective.
Cool. Divya, last word from you. A few things you would see corrected if you were to invest in the fintech space.
Ask me the few things that I would rather.
You would want it get better while you can put in money there.
Yeah, I think this whole, at least if I would use this word, growth at all costs or growth at any cost, and it's not just necessarily a fintech topic, it could be a VC topic, it could be a PE topic, any person in the stakeholder universe which is pursuing that. I think there comes a time where that becomes a meaningful issue, right? And I would rather say that one should pursue balance around that topic. Obviously, when you're beginning, there is a certain degree of energy that one needs to have behind it. The second, I think everybody's spoken about the regulatory archetype, I think, and the regulations that have come up, which have provided clarity to fintech, to the extent that the response time on some of those regulations, and some of it can come faster. I think it can just help settle the water level a lot earlier than perhaps it's currently happened. So I think those are the two topics, if I was to pull out, in some ways, then that's what I would say.
Thank you so much. We wrap with this. Thanks.
Thanks, Anshul.
Thank you very much, Hamsini. Very refreshing to see an investor, two banks, and a fintech on the same stage. We don't see that often. A huge round of applause for this session, please. Well, we are very, very excited to introduce our next speaker. Now, today the word fintech is buzzing, and there are thousands of firms that want a piece of this pie that promises to change how the banking and financial world has operated for decades. But if there's one firm that you call a pioneering fintech player, NSE would definitely come on top. The National Stock Exchange changed the face of trading in India by fundamentally changing how stock market transactions are done, moving from the open outcry system to electronics trading and facilitating electronic shares instead of physical shares. And we are very, very excited to have the MD and CEO of India's OG fintech, Mr. Ashish Kumar Chauhan, the MD and CEO of the National Stock Exchange. He will be in conversation with Moneycontrol's Mahalakshmi. A huge round of applause to welcome Mr. Ashish Chauhan.
First of all, Ashish, thank you so much for making time for this very special event. This is our second Fintech Conclave. And really, like Chandra said, fintech is a buzzword today, but you were part of the founding team that created, in a sense, the first fintech in India. The topic for today's discussion is building resilience as a fintech, which, of course, you've spent a significant part of your career building stock exchanges, first with NSE, then with BSE, now back at NSE. There is disruption that is happening in the industry. We will talk about that. But first, give us some anecdotes into those initial days of building NSE.
I think I can go on for the entire night. Books can be written on all those anecdotes, but basically, it came out of the Harshad Mehta scam as a reaction to the scam, saying the brokers are running the exchanges for their benefits, and we need to have the exchanges which are running by professionals. So that's where it came out. But effectively, when we were setting up, India did not even have good telephone lines. If you had applied for telephone line, it would take 5 years to come to your house. And most of the time, it wouldn't work unless you gave a lot of money to the linesman every month, right? So that time, and another experiment called OTC, I don't know how many of you heard of over-the-counter exchange of India, it had already failed. It was kind of a stillborn, right? And we had seen that if you have a bad telephone line, you can't have a real-time situation happening. So we said we will use the satellite telecom. But the satellites, India was sending satellites, but we were not using them for most of the things. And so we said we will use satellite telecom, and we went to the Department of Telecommunications. And for every satcom dish, which used to be like 5 feet in diameter, I had to take 60 approvals from pillar to post in every region, every place we used to put. And they gave us a bandwidth called extended C-band, because I heard some portion of that telecom revolution, 2004, 2014, lost decade and all. But NSE was the first wireless private network in India, because NSE set up the satellite telecom, which works on wireless. Of course, now Elon Musk is coming, and we will actually call him the pioneer, but it happened in 1994. And I had to get actually the import certificates. You guys might not even heard of import certificates. So I had to go and buy some import certificates from the market. And one of the more interesting anecdotes, we were setting this up, the SATCOM network and the IT systems and all. And we had two large guys coming to set up our 30-feet diameter antenna on Mahindra Towers near the TV tower at Worli. That was our office. And somewhere we were not able to get the equipments out of customs, because there were a strike of customs official for 40 days. And in between, those guys are waiting, and in between, a news came that there is plague in Surat. Again, many of you might not have been born by that time, but Surat had plague in 1993. And so when I used to sleep in the office, like most of you would be, and so at 3 a.m., two of those large guys, like WWF guys, now it's called WWE, but those two guys came with good body, and I was like very puny. And so they said, we need to go. I said, okay, go. I'll keep on working. They said, no, we need to go home. And I said, which home? When you have a hotel, go. They said, no, we need to go to USA, because there is a plague in nearby city, and we are very afraid. And I said, boss, you guys are so healthy, and I'm like very puny. I mean, if somebody has to die, I will die. What is your problem? Right? And they said, no, we'll go by the first flight out. So I had to wake up the main contractor, HCL Comnet CEO, and had to tell him that, boss, these guys are willing to go. He said, boss, there is no choice. If they want to go, you can't stop them. And so I said, okay, show me your passport. So they gave me the passport. I put that into my drawer, both the passports, and locked and ran away, saying, abhi jao. So that was, and then of course we had a lot of negotiations between their company, our contractor and me. And we said, okay, if we cannot get the equipments out within 7 days, then they are willing to go, because I knew that if they go, then they will not come back for next 1 year, because they are so afraid. Now, of course, COVID has what I call leveled the playing field. Everyone had it. But earlier, plague and other stuff only used to happen to what we call developing countries. But there are many, many such instances and incidents which were like very funny in retrospect. When I was going through it, they were not funny.
Right. Lovely story, Ashish. So, the original time in the 90s, the way you built fintech, obviously NSE was also built because the government wanted that infrastructure to come up. So in that environment, there are challenges like what you were talking about. In today's environment, there is a lot of the regulators are very active. For a good part, it's a good thing because we have a cleaner system, more transparent, minimize risk at the system level and all of that. But it also means that it's very fast evolving and business models have to evolve and adapt to that faster. What do you see within NSE? How do you navigate this whole environment? Because your industry has seen a lot of changes, very rapid changes in regulations over the last few years.
In a way, we are at the center and the brokers are at the kind of periphery to support the investors. And now it has become a very large ship, right? It's a 10.7 crore direct investors, unique investors. We have totally around 21 crore accounts, 10.7 crore investors, $5.4 trillion of market capitalization. So it's a very large ship, and you have to run it like a rickshaw. Somewhere something else comes, some cow comes, and the rickshaw fellow is able to do that. We are also told that now, tomorrow, this will be changing. Day after tomorrow, this will be changing. And we can't make mistakes, because if I make mistakes, it will create an issue with all the brokers. Even 5 brokers is going to be difficult, because if you bought at 100, like you type on Google, you ask whatever you want, Google will give you answer whatever they want. Both of them may not be connected, right? But in our case, it cannot happen. In our case, when you want to buy at 100, I have to give you 100. Today, on a good day, I get 2,000 crore orders. 2,000 crore orders in 6 hours, 15 minutes. That is around 15 orders per every human in India, every day. 2,000 crore is also larger than UPI does in a month, 24/7. And I give you response time in 100 microseconds, which is in 1 second has a million microseconds. I'm going to now go to nanoseconds, which is a billion microseconds, billion nanoseconds. And each time you put that 2,000 crore orders, I have to create an order book, give it to you without delay, and equitably to all, and stuff like that. So every time there is a change, it's like a new nightmare. And most of the changes come out of regulations, very little come out of the business requirements. And so they come out in isolation of your ability to change. And many of you might be going through that in your businesses, that suddenly the competition has changed, the regulation has changed, your regulator has mandated something, you have to do that, right? And you have to burn the sort of night oil or whatever it is called every day. So I literally today, it's a habit for now 30 years or 32 years that when I wake up, I look at my mobile in the night. When I wake up, anytime I look at my mobile and say, okay, things are going as per plan or not for 2 a.m., 3 a.m., 4 a.m., like that, right? So any change is a difficult change, but at our kind of scale and stuff, it's very, very rigorous testing that has to go through. We are also made to do every month a mock trade from our DR site, disaster recovery site. It has to have like exact 100, if I have 100 servers here, 100 servers there. And we do mock trading on weekends every month from the disaster recovery site. But twice a year, we do real life trading, live trading on normal days from the disaster recovery site. And one day SEBI said, no, now you have to close down halfway and take it up from the DR site. So we said, yaar, normal din pe nahi kar sakte, Saturday ko karte hain. So we did it, it worked. And then they said, no, but you actually shut down your production site on a gradual basis, on a predictable basis. So now it has to go down suddenly. So that is like a disaster. You recreate disaster. So we did that also. And so it's many of these things like DR sites and all, nowhere in the world actually people do real life anywhere. On not only stock exchange, no other thing, right? They create DR site and hope that it will work whenever it's required. Most times it doesn't work when production goes down, but it's like a insurance which usually doesn't come, right? But it gives you comfort till the time it doesn't come. So while as in India, our regulators want to check, nahi boss, ye barabar nahi kiya, wo barabar nahi kiya. So it's a regular, in a way, I've got used to it because of that is, in a way, I started the automation of stock markets in the world and have been there throughout, so it is okay. But any new person will find it very difficult.
And So, Ashish, the disruption that you're seeing in the broking industry and in the stock market exchanges, is this the biggest that you have ever seen? Because there's so many things that are happening together. One is this F&O regulations, which, helped us gain in terms of volume significantly over the last few years. Now it is also sort of something that will bring it down. Second is this true to label circular that SEBI brought in. Third thing is this SME, which is also growing very fast. Now SEBI is concerned that there is fraud in that area. They want to bring in tighter regulations into it, more vigilance on part of exchanges. So all of these put together, it's looked like a lot is changing. Is this the biggest disruption you have seen in your career? And again, you said, it's like the the rickshaw guy, spearing to, the cow on the road. How do you create this mindset and culture to cope with all this?
In a way, I think today what is happening is not even a fraction of what happened between, say, 92 and 2000. 92 to 2000 was a period in India's history which will never repeat. We created a completely state-of-the-art automated system for stock exchange, but it was also the first public digital infrastructure of India, where people from across the country could place orders and get execution done in 2 seconds. It was like magic. When I inaugurated the first terminal outside Mumbai in Coimbatore and placed an order, it got matched. That person couldn't believe. He said, "Bas, you're faking." And then every day news would come, कि satellite गिर गया, rumors that satellite गिर गया, ये हो गया, वो हो गया, NSE default हो गया. All sorts of things used to happen. Of course, BSE had a default called MS Shoes. Some of you from stock market might know, but it used to be like lots of rumors. And then we had a concept of margining system, which was always one-sided. That if market is going up, you will try to margin that side and all. We created a real-time margining system, first time in the world, and that clearing corporation came out of that. That's where the perennial defaults, BSE used to have, or all other exchanges used to have once in a year, once in 2 years, some default, and sort of market will be closed for a few days or a month, and then again they will start. So that got closed because we started putting settlement guarantees by taking real-time margins, calculating them, and then we set up a depository because we had fake certificates. Shares used to be certificates, and currency printing is still a crime. But share certificate printing, the police could not even understand how it was a crime. So everyone and their brothers started printing because printing technology improved. So color printing came at home. And the first thing people started doing was to start printing share certificates. And ACC and other things started coming. And one day I had like many shares started coming back from registrars. And at some point I had like 40 crores. In those days, 40 crores were like today's 400 crores. 40 crores rupees worth shares, which were fake, were delivered to us. And of course, we knew which broker had delivered. So we got him, we filed FIR, got him into jail. And while going into jail, he said, "Saab, aapne mujhe jail mein dala hai. Main to kal wapas aa jaunga, aapka kya hoga?" Right? So in a way, what happened between 92 to 2000, we put price bands today, what we call circuit breakers, all those things which are unique to India, although they are sort of given names of what New York Stock Exchange calls circuit breakers. It is not the same as what we do. Ours is a price band where prices don't move beyond those numbers. You cannot place orders and stuff like that. These were all devised because of the experiences we gained. And those kind of tumultuous kind of periods, in terms of regulations writing, doing sort of going back to writing algorithms to do that, coming back, testing, putting them live, those kind of stuff cannot happen because it's already, we have already in third, fourth stage of automation in our market. So I don't think what we are doing today is even remotely close to what was happening, the excitement. The entire country was changing. in some ways. And of course, the IT confidence of India came out of NSE, because that was the first large project in public. And then when Y2K came, every IT company worth its name, whoever are now billionaires, used to come to NSE with their foreign-looking customers, then show that Indians can do this. That's how they got those contracts. And that's where basically every person who wasn't even IT engineer, we had very few IT engineers, started printing certificates of the IT engineering also at home and started going to America and things like that. That's how we got the IT prowess. But most of it started from NSE.
Right. Unfortunately, Ashish, that's all the time we have. But just one last question. What would be your advice to the fintech founders of today?
Don't believe in your bluff. You have to be grounded. Things will happen. Whatever you pitch to your customers or your investors, but you have to be grounded, right? And I have been a serially failed entrepreneur, okay? So I can tell out of my experience that most of the businesses, however good technologically you are or a business understanding you have or anything, finally there are extraneous circumstances which may ensure that you may not succeed, but you still need to continue, be grounded and continue to work, continue to pivot all the time. We were actually, NSE when it started, it was supposed to be a model exchange for bonds trading. Can you believe it? 3 months we started, first month we started when Dr. Manmohan Singh did not even give appointment to inaugurate. So we started SAE. It is now called Beta. Gmail continued on beta for 20 years, but we continued on beta for 1 or 2 months. And then I think May we started, July he gave the appointment. He came and inaugurated. But within few months of that, the bond market started going down in terms of trading. And then one day my boss called saying, Ashish, now we are, I think it was August. And he said, now we are launching equities on November 3, 94, which is a Diwali day evening. And I said, boss, it was supposed to be 2 years, because those days programming used to be like very tough. Any change would take you months and years. And I said, boss, we are creating this new software which will take us 2-3 years. He said, no, nothing doing. Whatever you have to do, but November 3, 94 is when we are starting. And whenever I meet young founders or people working in fintech or any other areas, always they are under pressure, and I keep on sympathizing. But that is how life is going to be. You have to run very hard to stay at the same place on the treadmill, right? So welcome to the world of fintech.
Sure. On that note, thank you so much. Thank you so much, Ashish, for making time.
Can we have a huge round of applause for the fintech founder in the room? Many valuable lessons there, including don't believe in your own bluff and stay grounded. Thank you so much, Mr. Chauhan. Mahalakshmi, I'm going to request you to stay back, because now we have the regulator in the room. So for my next session, I'm very, very honored and privileged to welcome Mr. Anant Narayan, whole-time member, Securities and Exchange Board of India. Fintech founders always want to hear from the regulator in terms of how they need to prepare, navigate disruption, and how they can achieve that perfect balance between innovation and regulation. Take it away, Mahalakshmi. Can we have a huge round of applause for Mr. Anant Narayan? It's been a very hectic day for him. He had a board meeting. But sir, thank you very much for coming to our Fintech Conclave.
It's such a, I don't know how, I don't have words to explain. It's been such a long day for you, and we kept you waiting also. Thank you so much for making time and making the effort to be here today. So let me dive into this straight away. You know, the talk of town for the last 1 year has been these F&O regulations, which finally took effect on November 20th. We've just seen the effect of the first round of changes that got made on November 20th. Another 2 rounds to go. January 1st is one big thing. Looking at how things have panned out after November 20th, actually December 1st, what is your sense? Have you accomplished what you wish to accomplish?
Thanks a lot, Mahalakshmi and Moneycontrol, for having me. It's been a long day for you guys as well. And the regulator's job is to be boring and to put you to sleep, which is what I'll try and do. Look, as far as futures and options and derivatives is concerned, this is a journey. It's a continuum. It's not, discrete points in time that we're trying to do different things. It's a modulate as you go kind of a situation. Just to be clear, the objective, the regulatory objective that we had was not really against futures and options in toto, not at all. It was basically to address what we saw as egregious overtrading on expiry day in index options. So very, very specifically this particular segment. And the reason was twofold. One was we did see an element of investor protection kick in. We've been publishing these, research from SEBI from time to time, from January 2023 onwards. We, refurbished it again recently, which showed that well over 90%, 93% in the last 3 years of investors have actually been losing money in F&O. And despite these statutory warnings, including on broker screens, the volumes were continuing to grow. And secondly, there was an element of potential stability risk as well. So when you see overtrading and zealous overtrading happening on expiry day, with open interest actually increasing right up to a few minutes before expiry, then the size of the positions becomes so large that, God forbid, if you had a 9/11 kind of a global event, the stress results are becoming a little wonky. So this was a twofold objective of just focusing on expiry day index option volumes. The steps that we've taken are largely towards that. As you said, a part of it has kicked in so far. It's too early to tell what the impact is because, this is not a univariate equation of regulatory action taken and volumes resulting from that. You have to take into account seasonality, you have to take into account mood of the markets, you have to take into account what's happening, in the markets itself. And it's also December, November was a festival month. So it's very difficult to tell, but at least the first couple of weeks with all these caveats that this is not indicative of what's really happening or set to happen on a long-term basis. We've seen the notional volumes come down. It's come down by 35 to 40%. We've seen the premiums, in terms of premiums, the volumes come down by much less. It's hardly been some 8-9% down. And again, it's not very clear if that's the right trend. The option per contract or the value per contract has gone up quite substantially. Going purely by this and with the caveats that we don't know if this is the right trend to look at, given there are so many other variables involved, this seems to be in the direction that we wanted. After all, what did we want? We wanted the number of trades on expiry day to come down because there were really small option premium trades being churned every 3 minutes. So notionals coming down is a good sign from that perspective. Option premium itself not coming down by that much is a good sign. We want a healthy F&O market. And option size per contract going up by 50-60% is also a great sign. And remember, things like the increase in the notional size, things like less number of expiries during a month end, all that haven't kicked in as yet. That will kick in subsequently. So I think it's going in the right direction, but we are in no hurry to recalibrate what we've done. We will take a deep, long look at how things are panning out. One of the boards in my room says, first do no harm. We are not in a rush to regulate, to try and control the market. We know that's not the way in which the world operates. We'll take a nice long look at it. We'll discuss with the market participants and see if further calibration is required.
Right. So one of the things you've also, talked about in the past with respect to these recalibrations is that your worry about this expiry day volatility. And that hasn't changed, at least for the 2 weekly expiries we still have. Even last Friday was a demonstration of that. You had like a 2,000 point move. Is there any way but to do away with weekly options altogether to rein in this volatility?
So let's break it up into two parts, Mahalakshmi. Our intent was really to try and address over trading happening on expiry day in index options. We did not talk about volatility. Okay. We talked about the fact that there is too much of egregious zealous over trading happening, particularly by small retail investors in index options on expiry day. It was practically a game of 0 day to expiry kind of trading happening on expiry day. Now, that was our objective from both an investor protection perspective as well as a financial stability perspective. We did not talk about volatility per se.
Okay, so
Now,
volatility
having said
in
that,
itself,
on volatility, let's take the second part on volatility. Ashish was here just now. Exchanges as well as SEBI has adequate measures of surveillance, and we are constantly updating them. Trust us, we look at things, even when the markets are, even when there is no talk about what's happening in the market, there are enough checks and balances that we have. We have enough alerts that are coming up at all points of time, which are taken to their logical conclusion. So trust the exchange and SEBI ecosystem. Surveillance systems are in place. If and when we see something which is wrong, we will absolutely act. And we have not hesitated to act earlier.
sure. One question on the latest consultation paper on algo trading norms. What do you wish to accomplish out of this? And you've said that, you know, for black box trading algos, they will also have to, they don't have to divulge their strategies, but they have to keep records of all their data and trades and stuff like that. Do you think our regulatory system and the exchanges are ready to sort of take on this kind of data and prevent flash crashes and stuff like that, which is what I would think is the primary worry?
So first of all, this is being directly handled by my fellow whole-time member, Kamlesh Vashne. So I'm giving my personal views here. It's not something which I'm looking at directly. With that caveat, let me tell you what my personal views are. And I'm only one voting member of the board. I'm not the board as a whole. One is, I think the rationale behind having this algo trading being brought out in this fashion is to try and formalize something which we know is happening. If there is something happening in the background in an informal, unregulated manner, let's give it a chance to come to the open and become part of the ecosystem where everybody is taking a look at it. It's to formalize what is currently informal and give a chance for formalization. Now, personally, I would strongly urge investors not to be too enamored by these algos, particularly the small investors. Think of it this way. If there was a really smart algo which was designed to beat the system and to be, you know, constantly positive, what are the chances it would be offered to a retail customer for a fee? Yeah. You know, it would first be used by the algo provider themselves to generate nice supernormal profits. If you don't have sufficient capital as a algo provider, you would probably hitch up to a large institution or to a large client with deep pockets to then, you know, draw that capital to run this particular algo. Only in the off chance that you are a really bright guy who's come out with these fantastic ideas and nobody is listening to you, only then will you come to a small investor. So the chances that you are getting something which is a bonanza, frankly, is fraught with risk. The second point is, you know, something that we have discussed before, Mahalakshmi. I think it's important that investors understand, and FNO is a point in that direction. Trading a lot as a retail investor, research has consistently shown, is a great way to reduce your returns. The reality is the transaction costs, the taxes, you know, compliance cost, the fact that we charge you something for every time you trade, the fact that exchanges, the brokers, there are so many other frictional costs involved, means the house is loaded against you every time you trade. So as a retail customer, I'm not talking about institutions, I'm not talking about HNIs with deep pockets. As a retail customer, the more you trade, the less you make is what research consistently shows. Now, if you're fully aware of this and you still want to deploy your hard-earned money into various, you know, enterprises, that's your prerogative. By all means, do what you're doing. We are not a nanny state, as my chairperson has often said. You are free to do what you have to do with your money, but just be aware of the risks. When we said 93% of retail loses money, there is a reason behind it. We saw this for intraday trading as well. 70% of intraday traders, particularly the small guys, lose money. So reality is, as a small investor, your best bet is to do the right asset allocation, to stick with that asset allocation, only trade to either add to your investments or to rebalance your asset allocation. That's your best bet for making long-term meaningful returns. Now, of course, there will be people who trade and make money, but that's like a normal graph which is skewed against you, where the bulk of the people will actually be losing money. There'll be a few outliers who actually end up making money. So my earnest request would be, while we have made this algo provision more as a reason to formalize the whole process, please do not take this on face value. Remember that, often algos are curve fitting exercises. They can be back tested to show fantastic results, but past is not you cannot be extrapolated to show what happens in the future. Do not look for this, magic snake oil, which will make you a billionaire overnight. That doesn't exist in reality. Be aware of these risks and then take your call on what you want to do.
Okay. We don't have much time. Just one last question again. There is a feeling in the industry that regulators, all regulators, whether it is SEBI or RBI, there is a lot of changes that are happening, and it makes life difficult for them because they have to constantly adapt to whatever it comes your way. What is your thought, and what is your comment on that? And secondly, what is your advice to the fintech founders here in terms of how do they cope with all these changes that come their way?
So, partly in jest, and thank you for saying this is the last question. Partly in jest, we had this bunch of foreign portfolio investors who came to visit us. And one of the comments that I heard my fellow board member make was, the reason foreign investors like India, and this is in the medium and long run, is because we are like this 15, 16-year-old showing a lot of growth pangs, right? We're actually growing quite rapidly. We have fire in the belly. We want to actually prove ourselves. There's a lot of angst. There's a lot of aspirations. So we are like this teen with a lot of growth pangs, right? Now, you can't expect an economy to be like a teenager with growth pangs and to have the regulatory sagacity of a 60-year-old, right? So you will find that it goes together. Now, jokes apart, this is something that we think about a lot. And I've said this before, and you're going to fall asleep hearing me say this again, Mahalakshmi. We worry desperately about two kinds of errors that we could make as a regulator. The first error is when we let something bad happen. So when a Harshad Mehta happens, or a Ketan Parekh happens, or any other scam happens in the US, and Enron happens, FTX happens, or whatever, that's a type 1 error. And the inevitable questions from many in this audience, and Mahalakshmi herself, will be, what on earth were you guys doing? You were sleeping at the wheel, and didn't you know the whole world knew this is going to happen, and you guys are clueless. So that type 1 error is what keeps us awake at night. That tomorrow, if you have a cyber attack, tomorrow, if God forbid something goes wrong in the exchanges, tomorrow, if there's a scam which is unearthed, that's a type 1 error we will never, live beyond. But we are equally conscious of the possibility of type 2 errors. And that is when, in our zeal to reduce type 1 errors, we make regulatory frameworks so onerous that it comes in the way of good people doing their business. That's a type 2 error. And I assure you, we give equal importance to both. Because after all, our job as a regulator, if you look at the SEBI Act, if you read the entire SEBI Act, don't even read the entire Act, just read the preamble. It talks about investor protection, it talks about market development, it talks about market regulation. Those are the 3 pillars of our mandate, which essentially means capital formation. So while you think of us as this nasty regulator who's issuing circulars by the dozen, our job is to actually ensure that capital formation, that cycle, continues in a nice, robust, sustained manner, which means savings come into the capital markets that is used by issuers to raise money, to set up businesses, create jobs, therefore create more savings and make it a nice virtuous cycle. That is our job. So when we create type 2 errors, or when we create the room for type 2 errors, we are not delivering on our capital formation mandate. So what do we try and do to avoid this type 1 and type 2 errors? And by the way, we have to minimize both. If you're a statistics student, you will say that's impossible. You can't minimize both together. This is where the analogy stops. We can actually try and minimize both. This is not statistics. So what do we try and do? We start off by realizing and recognizing that we don't know as much as the industry does. Sitting in our ivory towers in SEBI, there's only so much we know. We have to constantly speak to you guys and girls to figure out what the hell is happening on the ground. Okay? So the need for consultation is something that is ingrained in our DNA. So every time we face a problem, a regulatory objective, either to ease of doing business or to actually come down on regulatory, to curb some regulatory malpractice, we do a lot of consultation at multiple levels. First, we have advisory committees. We have multiple advisory committees from our primary markets, secondary markets, for mutual funds, for AIS, for FPIs. So we go to the advisory committee. This advisory committee has some great people, experienced people from the industry as part of that. We then launch a public consultation. My strong advice to you, if you're part of this industry which is suffering because of regulations, talk to us. We look at your feedback to the public consultation. Today we had a board meeting. Every single board item had, here is a public consultation, this many voices for, this many voices against, what were the major issues against, what is our view on it, what is the relaxation therefore we are doing, or why are we not going ahead and listening to what the feedback is. And by the way, because we are subject to all sorts of reviews as a government entity or a semi-government entity, we have to look at every single feedback that comes. For the FNO, we had more than 10,000 pieces of feedback which came, and we went through every single one of them. So talk to us, tell us what's going on, and even better, if you can put together an industry, a CII, ASSOCHAM, or in the case of FinTech, if you have a association of sorts, which can give a unified voice, that really helps us. We need trusted advisors who can come to us and say, you know what, this is the right thing to do, stop doing this, stop doing that. So talk to us in the consultation. And it doesn't stop there. When we come out with a regulation after all this consultation, when we translate that to do's and don'ts on the ground, even there we consult with the industry. So a regulatory intent converted to do's and don'ts goes through something called a standards forum, which includes industry. In fact, it's led by industry in consultation with us, saying this is your regulatory intent, therefore these are the do's and don'ts at the ground level. Again, please consult with us on that. Be part of that consultation process. We would love to hear from you on that. So last piece of advice to you I have is, and I've been on the other side on industry for a bulk of my time. I've only been a regulator for 2 years. Having seen both sides, I can tell you one thing which works. You have to be a trusted advisor to the regulator. That's important for you, that's important for us. If we see you only talking about type 2 errors, ki ye regulation ganda hai, when you're turning a blind eye to what we can all see are egregious type 1 errors where malpractice is happening, then we can't trust you. What we would much rather is, if you see something going wrong, please come and tell us about it. We would much rather hear about it from you than from our inspections or from our friends in the media or from other intelligence. You tell us, listen, this is what we think is, this is not snitching. This is taking care of your own ecosystem and preserving that goose which is laying golden eggs. So become trusted advisors, advise us. You will find we are more than happy to listen to unified voices coming to us and teaching us what needs to be done. So look, regulations are far too important to be left to the regulator. You have to be a part of the process. We have tried to make sure this is a consultative process. Talk to us. Trust us when we say we listen to you, talk to us.
Sure, that's a beautiful line. Regulation is too important to be left to the regulators. On that note, thank you so much, sir, for making time today. Lovely talking to you as always.
We hope the fintechs in the room were listening closely, become trusted advisors to the regulator. Huge round of applause again for Anant Narayan. Thank you very much for making time after board meeting. With that, we jump into the final 2 sessions for the evening. Thank you for being a great audience. Now let's bring the spotlight on someone that's building the next financial services powerhouse. They are there in multiple businesses. To understand the next chapter for InCred, please welcome on stage Prithvi Chandrasekhar, the CEO, Consumer Finance, InCred. Huge round of applause for Prithvi Chandrasekhar. Prithvi, thank you very much for talking to us. And, wise words of advice from the SEBI member. But how has it been for you as far as the regulatory aspect is concerned? Because InCred, it's seen such rapid growth in the last 8 years, right? And today, I think you're there in 3, 4 businesses. How has it been for you? For Bhupinder to kind of turn from a career banker at Deutsche Bank to building this financial services powerhouse.
So yeah, thanks for having me. And I'll keep my answer brief. I'm aware that we're, at the end of a long day. We're actually in 8 different verticals now in
Wow.
consumer
Okay.
finance.
Looks like I missed 3 extra
Yeah.
ones somewhere along the
Yeah,
way.
and we also have InCred Capital and InCred Wealth, which are sister businesses on the same brand. To your question about the regulator, we actually try to engage with the regulator as closely as possible, understand what the intent of the regulator is, and stay within that intent. And to the point about trying to speak with a unified voice, I'm actually in 2 such industry forums: the DLAI,
The Digital Lenders Association of it.
and FACE, which was mentioned earlier today.
Yeah. Which is a fintech SRO.
That's the newly appointed fintech SRO. DLAI hopefully will become an SRO shortly as well. And we really try and engage with the regulator on that. I could almost, validate what Mr. Anant Narayan was saying. We were fortunate to be in on a whole bunch of consultations with the RBI. In fact, shortly after the DLG came out, but a lot of the clarifications, a lot of the pragmatically, how do we make this work? Yes, they did listen to us. I think the deeper point is that what we want in the industry and what the regulator wants is basically the same. We want stability, we want clarity, we want to be able to attract investors who are confident that the goalposts aren't going to change. We want to protect the end customer. Our intent is very much the same.
Right.
On the other hand, we don't want surprises. I understand that sometimes it is needed, but when there is a surprising event in the market which hasn't been through consultation, which people aren't already talking about, that can create a lot of, worry, a lot of consternation in the system. But yeah, I mean, to answer your question as directly as possible, I think the key is just stay engaged and don't panic. In 8 years in India, we've lived through demonetization, GST, Supreme Court ruling on Aadhaar, ILFS crisis, DHFL crisis, COVID-1, moratorium.
Yeah.
Now recently the DLG, the comments about what is usurious and what is not, which we will discover. But I think it's also important, speaking to my fellow, operators rather than regulators, don't panic, stay engaged with the regulator. We can make it work.
Great. That's a good message. I think fintech founders after a point become motivational speakers because, they've seen everything, dealt with, all the knowns, unknowns, unknown unknowns, and so on.
Yeah.
But
no, so to that, I mean, we actually had a session with one of our early investors, and we've been operational. We've been operational in India about 8 years now.
Right.
And about the many, almost, auto rickshaw swerves that we were talking about a few minutes ago that we've had to take. And Bhupi's comment was, in 7 years in India, you'd live through 21 years of experience in any other market.
Wow.
And I think that's great, right? That's part of the fun of being here. That's a part of the opportunity we're faced with. But that's also kind of the reality we're going to, deal with.
Right. You mentioned early on that InCred's now in 8 verticals.
Yes.
Which is your fastest growing one, which is going to be the one to watch out for in 2025, the one that you will double down on, triple down on?
The better answer is all of them will continue to grow.
That's also a diplomatic answer.
No, the fastest growth will be in our LAP vertical.
Okay.
Or more specifically, our secured business loan vertical. And that speaks to a couple of the themes that have been talked about on the stage through the day. The huge opportunity in secured, a lot of the explosions that we've seen in terms of, credit access has been in unsecured. And in business loans, a lot of the, fantastic growth we've seen has been in household or consumption finance. And that's pretty much waiting to happen in both secured and in MSME. And we are doubling down on that segment. So are many other players.
Yeah,
but
in fact, we
that's-
have a lot
yeah.
of MSME lenders in the room, from
Yes.
Mintify to Servagram to Flexi Loan. So maybe you
Yeah.
guys can catch up after.
No, we talk quite a lot, but it is also something that the regulators are actively encouraging. It is also something that's much easier for us to do now than 8 years ago. Our cost of funding is different. Our operating leverage is different.
And it's
So-
also red hot this year in terms of funding. So
Yes.
yeah,
Yes.
yeah.
So that will grow, but so will personal loans. So will student loans. So will, our digital anchor-backed digital loans, right? So we have a whole bunch of verticals, all of which will continue to grow. But the big move we're making is on secured business loans.
Right. But, at the same time, I think unsecured personal loan book constituted almost 44% of your AUM today. And it's been quite a volatile year for this segment with the RBI tightening norms. So how did you sort of navigate that curveball?
Yeah, so this is the business I'm personally closest to and have been since inception. Really, the question there has been less about the RBI and more about a changing landscape, right? If you look at even the CIBIL data, or yesterday I got the Equifax report, lending in consumption loans, whether it's personal loans, credit cards, or consumer durables, is down in nominal terms about 7-8%, right? These are verticals where in the last 5 years we've doubled, and in the 5 years before that we doubled again. So in 10 years, the disbursal volumes in these verticals have increased about 4x. And suddenly in an economy which is growing maybe 6%, 7% in real terms, 10% plus in nominal terms, we're seeing a very sharp slowdown in disbursals. Now, obviously that's been, intentional slowdown from the regulator, but that has a whole bunch of knock-on effects on our, distribution partners, on the customers, cash flows, because this has happened suddenly, on, collections volumes, for example. So it's been actually, I think, dealing with a slowdown, which has been partly, prompted by the RBI and the tightening of rates, some of the
Right.
Regulatory actions they've taken. It's been less about specific regulations, all of which we've been well within for a long time. Right? I think it's really, the last set of big regulations we had was the DLG, which came out in 2022. And I think most of us in the industry have implemented them. But I think it's more about the rate hike, the slowdown in total lending, and dealing with the consequences of that, which we are dealing with, frankly, fine. But my view is that that's a temporary slowdown. In an economy which is growing at 10, 11, 12% in nominal terms, consumer credit will bounce back. That's the natural thing. And once the correction has happened, it's a question of when rather than if we will see the bounce back.
But do you expect the cost of credit to sort of, moderate in FY25? Or
The
rather
cost
FY26?
the cost
yeah,
to us or the cost to the end customer?
to both.
I don't expect it to change a whole lot. I don't expect it to change a whole lot. I think it's been in the same zip code for a long time. I think there's been some talk about a clampdown on super high rates.
Yeah.
Say triple digit rates.
And we saw that recently, right?
Yeah.
With Navi and DMI.
Correct, correct. And that brought up the word of, what is usurious, and,
Yeah.
I hope I'm pronouncing that correctly.
Yeah.
It's come into the limelight now. and what is not, right? But a lot of those, super high rates often looked at in terms of APRs, including the processing fees. I expect there'll be a sharp reduction in those. But if you look at the weighted average borrowing rate for the end household, most of the volumes are done at fairly normal rates.
Yeah.
15, 18, 21, 24, very little above the 30% mark. And that's where most of the volumes are anyway. And I really don't expect that to change very much. That's driven more by risk profiling than by actually the cost of funds. The bigger cost is the risk cost. I actually don't expect that to change, even from a macro viewpoint, because as there are more and more people getting access to cheaper credit, as they kind of move up the credit ladder and access, say, bank credit, there are ever more hundreds of millions of Indians coming through who are still credit hungry and need credit to move up that ladder. So I really don't see that changing in the next year or even for some time. The top end of, eye-catching, what may be considered egregious rates, I think will reduce a lot. But if you look at the weighted average, given the loan ticket size, I don't think that will change much.
Right. And how do you see the overall consumer lending space? You mentioned a blip in terms of the demand, or a reflection of the overall growth that India's seen.
I just want to be clear there. I think it's a blip it's more about supply than demand.
Right.
I don't think there is much of a slowdown in demand. And if anything, as and when the landscape comes back to normal, as it will naturally, given the natural growth rates of our economy, supply will catch up with demand. If anything, there might be a little bit of pent-up demand, but really I'd expect it to come back to normal. The fundamentals which were true 10 years ago are still true. We're still a credit-hungry economy. We're still an underinsured economy, to one of your earlier panels. We're a fast-growing young country. Credit demand will return, and credit supply will catch up with demand.
Right. One big theme that we've seen this year is a lot of new age companies tapping Dalal Street, and the response of retail investors has also been very good. Now, I read that Incred also has IPO plans. You aim to raise 4,000 to 5,000 crore at a valuation of 15,000 to 22,500 crore, and you're targeting a listing in the last quarter of 2025. Take us through your IPO.
So this was today's news, right? And it was not something that I or even Bhupi has proactively shared with the market. But yes, it is quite well known. We've been talking about accessing the public markets for several months now. It's a question of when. To the point about we're navigating the downturn well, we've just had our half-yearly results, which we're very happy with. And I mean, it's something we're considering. There are many uncertainties on the way, including, to the previous speaker, filing with SEBI, getting the right blessings, going through due process. So will it be by Diwali next year, which is what the paper said today? I don't know. I have no
prediction, Prithvi, then we can ask you in the next Fintech Conclave. Maybe you'll be listed by then.
We definitely will be listed. It's a question of, will it be Diwali or Christmas or Holi or when, right? But we will definitely be listed, and that's not a revelation. That was always the plan. And as a now fairly big NBFC in a very capital-hungry business, is that the natural path? It is absolutely the natural path.
Right.
And always was, right? And to, in fact, some of the other panelists and speakers earlier, we never were a tech company where our end customers are actually, buying tech, and our product and our investor profile is a capital light business. We've always been a, on balance sheet NBFC, which is capital hungry. And therefore an IPO, you don't have to be a, fortune teller to know what's coming.
Right. Fine. Final question to you. You mentioned that you're in 8 different areas. Are there still 1 or 2 white spaces where perhaps, you're not there today, where you will be, say, a quarter from now?
Uh, a quarter from now,
Or
probably
a quarter
not.
of 2 from now. Let's
Yeah.
make that 2 quarters.
Actually, no. Right? Because, I mean, very simply, it takes much longer than that to spin up a new business. That said, I mean, the way we think about our business is we're diversified for a reason. We love the stability and the risk diversification that we get from having multiple verticals which are not correlated with each other, and the operational leverage and the, the tech platform, the access to liabilities that all of that provides. The way we think about it is that every 12 to 24 months, we invest in a new vertical, discover the right operating model, the right price risk balance in that new vertical. The investments currently are happening in secured business loans. So perhaps if you'd said in the next 6 quarters, I'd have said definitely yes, but I don't know what it is. But in 2 quarters, actually no.
Great. On that note, thank you very much, Prithvi. And here's wishing you and Incred the very best as you pursue a diversified strategy. Thank you.
Thank you. Thanks very much.
Thank you, Prithvi. And with that, ladies and gentlemen, we come to the final session of the evening. This is something that we're very excited about because, while we talk of a funding winter, there's been one segment within fintech that investors really seem to love this year. It's been a red hot space attracting a lot of investments. We're talking about the MSME lending space. To tell you about what's hot about the MSME lending space, will the run continue? Will the gold rush continue in the coming year as well? Please welcome on stage an investor, in fact, who's going to moderate this discussion, Kaushik Anand of A91 Partners. Kaushik looks at the fintech space very closely at A91, and joining him on stage are some of the hottest MSME lending fintech startups this year. Anup Agarwal, co-founder and CEO of Mintify. Utpal Isar, co-founder Sarvagram. Deepak Jain, co-founder Flexi Loans. Sayali Karanchkar, the co-founder of PaySense, who's currently the chief business officer at Elastic Run. A huge round of applause for all of them.
Hello. Thank you, everyone. I know we are sitting between you and dinner, so we'll try to keep this quick. It's the first time I've seen NBFC founders hungry. Generally, they're just hungry for cash. But to start with, just quick intros. We'll keep this brief. As Chandra said, represent A91. I'm a partner there. I focus on tech and fin services. You guys can just.
Hi, I'm Deepak Jain. I'm one of the co-founders at Flexi Loans. We are an MSME lending fintech, as been announced already.
I'm Utpal, and along with Samir, we are co-founders of Sarvagram. We are an organization focused on rural mid-income households, trying to get them to their next orbit of affluence.
Hi, I'm Sayali Karanchkar. I'm the co-founder of PaySense, which we exited to PayU a couple years ago. Since then, I've been advising and being a board member in few fintechs, one of which listed today, MobiQuick. And I'm now CBO of Elastic Run, where we are financing rural commerce.
Thank you. Good evening, everyone. I know it's been a long day for you guys. So thank you for your patience and still continuing to hold around. So I appreciate all you guys being around. My name is Anup Agarwal. I'm co-founder and CEO of Mintify. It's a supply chain financing company focused on providing inventory financing solution to SMEs in India.
Thanks, everyone. I think we'll start with a little bit of a basic question I've seen as an investor, which is whenever we meet companies where they don't yet have a revenue model, when we ask them, how will you make money? They say lending. So let's maybe start with this side. When both of you guys do lending 100% of your time, just give us a couple of examples on why is it difficult? Why can't people just do it like as a feature?
So, so Kaushik, again, a great question. And at Flexi Loans, we give loans to small traders, retailers, wholesalers. And when we were starting lending, we said, how do we acquire these customers? And we said, we'll go to ecosystems and start something called B2B2B.
Now there's a cool term for it. It's called ecosystem embedded financing. So we were the ones who started and convinced a lot of these ecosystems that you can start lending and you can monetize your MSME ecosystem through lending. Now, why? It's not a feature because it's not core to many of these ecosystems. So many of these ecosystems have a fantastic large business, right? So for example, the entire e-commerce ones, they have their own troubles, their own fires to be doused. Why would they focus on a lending, which is another massive game in itself? Similarly for payments, for ERP, each one of them. So first of all, it's not a side gig, it's a main gig. So people who want to do lending, even the ecosystem, they'll have to focus equally big on lending. And because lending has acquisition, underwriting, collections, and capital. So there are four large pillars to focus upon. So it cannot be run as a money churning side gig. To me, that's the key reason why it
I
cannot
think
be
just
as
to
a
add to
feature.
that, the most important pillar is a regulation. Most people tend to forget that's a highly regulated business, Kaushik. And till the time you don't have the mindset of being regulated and follow very very tight guidelines in this country, you may probably not be able to build a long-term sustainable business model. So I think regulations is something which is very key to anybody who's thinking about lending model.
And lending is difficult because actually it is the business of measuring the ability and intent of the prospective borrower. And that you can only do, in my opinion. I've done this for the last 25 odd years in a large bank and then in my own startup. Only way you can do this is by doing a 360-degree appraisal of whichever unit you are choosing to lend. Individual slivers of data may give you a view, but will not give you a full view. And because the business is collections, not disbursements. In fact, my boss at my previous organization used to say that disbursement is an expense and collection is actually, the revenue. And that's something that we've held on to. Therefore, Kaushik, it's difficult.
Switching gears a bit, on the panel, we have it's fintech. So we have Flexi Loans, which is mostly sourcing online. I think Sarvagram, which is mostly offline, and Mintify, which is maybe somewhere in between. Just walk through the choice. Why do you operate or source customers in the way you do?
So again, before I started like Flexi Loans, I was a banker like Anup for almost a decade and was fortunate to do a lot of IPOs and quips for many large lenders, NBFCs, banks, etc., etc. And one thing which always stood out, when Bajaj started or Chola or South Indian Bank, everybody had an origination mode, which was different than the incumbents before them. So we said, okay, what's missing? And there was no digital only acquisition models. And can you test it out? Can you build something like that which is at scale? In 2016, it was an idea which felt like not doable or not achievable. So we said that okay, we'll crack it, because in the global economy, a lot of people were already doing it. And there are two methods to do it, right? One is you go to ecosystems, and there was a company called Cabbage which used to do it for PayPal in the US. So can you replicate that in India? And we did that for Amazon, Flipkart, Paytm, etc., etc. Then once you know the persona of the customer, can you use the data science analytics to acquire those digitally? Now, what this does is you don't need to open branches. You don't need to be worried about branch unit economics, the burn of the branch, etc., to acquire your customers. Now, as long as you can underwrite and as long as you can collect, you can source it from anywhere in the country. So that's what we wanted to crack, and I think.
Utpal, why does that not work in your model?
No, it works well, Kaushik. It's just that you don't have a choice to be only physical, and you don't have a choice. I think now it's been also proven by the last couple of quarters that you see you can't be purely digital. So we as an organization, we call ourselves driven by data but delivered by humans. So it's a function of right from the top of the funnel to the entire life cycle of the customer. What are the stages which you can do digitally without compromising on the bread and butter, which is the ability to underwrite 360 degree? And that we find inside our organization, various swim lanes for various categories of borrowers that come in. Some of them could complete their journey about 50% digitally, And 60% of our customers now, we pull their bank accounts with their consent through the accounting account aggregator. Even in pure rural, we only work in deep rural. So it's a question of what is the customer segment looking like, what are their behaviors, habits, and how much digital can you go with them without compromising on quality.
Sure. I think maybe to Sally, I think we've heard some amount of tech in what Anup and Deepak described. When you ran Patience, how did you balance between the fin and tech side of things? Which took more precedence and how did you balance it?
I think the precedence was decided by why are we using the tech. So if we look at our consumer segments, we were using tech to be able to underwrite people that you cannot underwrite physically. Their income is highly variable or their data on the bureau is very thin. So then we built models which find consumers who are like them in different ways that we know about, and then use that to model risk on the ones that we don't know about. So that was a reason to why use tech, or to change the cost to serve, to really be able to do this business at a super low cost to serve by acquisition or even by customer service or even by collections, doing tech to a large part, and then when needed adding the physical layers, doing tech to a large part where adding the bots was spoiling customer service, but not. So then let's not do bots to the end consumer, but let's do bots to our customer service agents so that they can serve the customers better, faster, and with more accuracy. So the why we are using tech was always very important, to give the right precedence at every step of the way, whether it was acquisition at a low cost or underwriting a lot more people than we otherwise could, and serving a lot more people in their own languages with bots or with the right physical touch points. So that balance was always there. But because this is a heavily collections and risk oriented business, we first built that. We first built a very, very strong collections team. In the fintech story of the 2015-16, it was very unheard of. Many people asked me, why are you getting these very traditional collections teams set up? It was because they were teaching us what they really knew and what we really needed to know, and then we could productize it. Then we could train our data models on it. We needed the expertise to then build the tech to lower the cost for scale.
Shifting focus a bit, we've been reading a lot about this unsecured loans coming down, especially on the consumer side. This is maybe more to Anup and Deepak. You guys are necessarily not offering property-backed loans. So in the more recent last 2-3 quarters, has there been any impact on the business loan side in terms of lenders, any part of the ecosystem sort of pushing back?
I think our panelists before this session also spoke about it. Clearly, there was some amount of concerns that the regulator had, and earlier this year they also kind of increased the risk weightage on unsecured lending. But one thing that you would consistently see from the regulator is the support around the SME lending has been very, very strong. Even in that particular regulation, they very clearly carved out that this risk weightage increase is not applicable for anybody who's doing SME lending, particularly focused on the PSL, which is the priority sector lending. So for us, and whatever we talk to people in the ecosystem, we haven't seen any impact whatsoever. Of course, when excesses gets created, I think everybody in the ecosystem suffer. It's just not to say, hey, is it bad loans getting created, or is it the regulator is concerned? I think as founders, we are also equally kind of hurt or equally impacted if our loan book doesn't do well, right? Our cost of funds go up, our ratings kind of get cushioned, and so on and so forth. So I think nobody is trying to kind of create excesses here. But at the same time, I think there is a real need for financing in the SME segment. This is not, in a manner speaking, a consumption which can be postponed, which can be deferred. People are essentially looking to just better their lives. Please understand, SME lending is extremely important for helping the overall, the GDP of this country and the lifestyles of these people to improve. And the regulator has always been super supportive in ensuring that whatever financial inclusion is possible should be made available through the MSME lending.
I think so just to add, and what Anup said is absolutely true, that see, MSMEs are the lifeline of the country, right? And they're not only generating employment, but they're also generating a lot of consumptions in the tier 2, tier 3 towns especially. For us, we see that performing really well because majority of, like almost 75% of our lending is in tier 2, tier 3 towns. And we are at least not seeing any slowdown in the borrowing from these MSMEs, because as Anu pointed out, that they are investing. This money is not for consumption. This money is for investments in their business, and they take a rupee from you to make 1.5, 2 out of that. So we are seeing, in fact, a lot of demand from these markets.
Fair enough. I think one of the interesting things is all three of the NBFC founders here have raised substantial amounts of capital recently. I think maybe Anup a couple of times this year. So we keep reading about funding winter on Moneycontrol, other sources. Is that not real? Is that only in Bangalore?
Well, well, just once, not a couple of times, but thanks, Kaushik, for that. No, I've always believed, and not saying because we've been fortunate to raise capital, good assets will always find takers, whatever the market conditions may be. If you continue to build good businesses, profitable, long-term, good governance, well-regulated, markets may kind of defer the decisioning on whether to invest now or maybe invest after 6 months or 1 year. But solid businesses will always get rewarded in the market. And that's what, at least for us, we are seeing that. I'm sure everybody would agree with the fact that, so to say, FAF cannot take you so far. It's the solid businesses that will take you, right? And that's essentially what we need to do.
And what winter, summer? When it is winter in London, it is summer in Cape Town.
Right? Fantastic.
So,
maybe last question, and we'll start with Saili. So why do 18-year-old Stanford dropouts not start lending businesses? Why do they want to deliver kiranas?
They really don't want to go collect the money back. But
The
this
18-year-old won't know how to spend it. We have to collect the money in the lending business, you see?
And I think we were discussing earlier, leave something for the grown-ups, right? No, but it was one of our pitches, right? We used to, when we were pitching for our early rounds, we used to start our pitch with, I'm 35, I'm 37. It's like something to be very proud about, that this game takes grown-ups. This game is very, very serious, and it takes grown-ups to take this forward.
I'm still 18. I didn't go to Stanford, but I'm very much 18.
Thank you.
Thank you, everyone.
Can we have a huge round of applause for the final panel? Excellent insights from some of the hottest MSME unicorns, sunicorns, startups in India. Thank you very much, Kaushik, for moderating that so well. With that, we come to the end of the second edition of the Moneycontrol Fintech Conclave. Thank you very much for joining us.